Hello students, welcome back everybody. So I'm back with another video, and in this video we are going to revise now the next most important chapter, which is going to be audit reporting. So this video I'm going to do one quick revision, at the same time one comprehensive revision of the chapter called audit reporting, which carries a very good weightage in the examination, and also from the practical perspective it is going to be very important. So without any delay further, let us directly start doing the revision of this chapter, audit reporting. So what exactly is this chapter made of? So first, if I put out the context which is there in this entire chapter called audit reporting, see, this chapter is actually a combination of four standards. And basically, this is the chapter which is going to talk about how to prepare audit report, in what format audit report has to be prepared, what content should be there, what terminology should be used. So all these things, that guidance is contained in this particular chapter called audit reporting. So if I tell you what exactly we are supposed to cover as a part of this particular chapter, so as I was saying, there are four standards, 700 series of standards, which are talking about the preparation of audit report and its contents. So those four standards are going to be SA 700, then we have SA 701, then we have SA 705, and then we have SA 706. So these four are the standards which are going to give a comprehensive guidance regarding how to prepare audit report, terminology, format, sentence formation. So all that guidance is there in this particular four standards: 700, 701, 705 and 706. Along with that, there are certain sections of the Companies Act which are putting some extra reporting requirements on the auditor in the auditor's report. So there are three sections actually of the Companies Act which are putting some additional reporting requirements on the auditor, which are going to be 143 subsection 1, 143 subsection 3, 143 subsection 11. So this things which I have listed down here, these four standards: 700, 701, 705 and 706. Along with that, three sections of the Companies Act: 143 subsection 1, 143 subsection 3 and 143 subsection 11. All of this put together will make up this chapter called audit reporting. And once again I am telling, very important chapter, both from the examination perspective as well as from the practical perspective also. It is going to be very important. So now we will start revising with SA 700. So SA 700 is the basic standard which is going to talk about what and all are contents of the audit report. What should be the format of the audit report? That discussion was given under SA 700. So let us try to understand now. Let us try to revise now quickly the standard which is SA 700. We will start with that. So once again I am saying, if you want to download the material which I am showing here in this video, please check the description below once. There I have given complete details how you can get access to the material whatever I am showing you here. So we will be starting our revision with SA 700, and as you could see, the title of the standard is Forming an Opinion and Reporting on Financial Statements. So as we all know, the ultimate objective of the auditor is to express an opinion. First, you have to form your opinion on the basis of whatever audit evidence you have gathered. And once you form that opinion should not be kept to yourself. That opinion should be expressed. And how that opinion will be expressed? That opinion will be expressed in the form of a written report, which we call it as an audit report. So auditor's ultimate objective is to express an opinion, and how to express that opinion, not just coming before the shareholders and saying it orally. That opinion needs to be expressed in the form of a written document. That written document, in audit terminology, we call it as audit report. And how to prepare that audit report, that is what this standard is going to exclusively focus on. So now in this standard, there are so many contents which have been given. But first, I will take you through directly the contents of the audit report. What exactly should be the contents of the auditor's report? So here I have listed down the contents of the audit report. As you could see: title, addressee, opinion paragraph, basis for opinion paragraph, material uncertainty relating to going concern, key audit matters, emphasis of matter, other matter paragraph. Then we have responsibilities of management for financial statements, auditors' responsibilities for the audit of financial statements, reporting on other legal and regulatory requirements, signature of the auditor, place of signature, date of signature, and finally, you did. So these should be the contents in your audit report. Now we will try to revise each and every content in a detailed manner. So what will come in the title? So generally the title of the auditor's report should be independent auditor's report. What should be the title of auditor's report? The title of audit report should always be what? Independent auditor's report. So for example's sake, we will take one live audit report. So we will try to revise the things simultaneously along with a practical perspective in mind. So we'll download one, or I will show you one practical audit report. With that, we can take the practicality and conceptual clarity both hand in hand. So let us do it now. So for example's sake, I will download the Reliance Industries Limited audit report. So we will have a look at that simultaneously. So let me open that material here. So this is what the annual report of Reliance Industries Limited. We will directly go to that particular section of the annual report which contains audit report. So this is what the audit report will look like. This is the audit report given by auditors of Reliance Industries Limited. And the first and foremost content of the audit report, as we have read in the standard, is what? Title. There should be title. So if you see here, the title is given. What is the title given? Independent Auditor's Report. So the title should always be Independent Auditor's Report. Now after that, the second content which should be given is addressee. Now who will be the addressee? Addressee in the sense, through the audit report, you are expressing the opinion. To whom you are expressing the opinion? So that addressee you have to mention. And if I say addressee depends on the client's organization. Like if I am conducting audit of a company, my addressee will be shareholders of the company. If I am conducting audit of a partnership firm, my addressee will be partners. If I am conducting audit of a sole proprietorship firm, my addressee will be the concerned sole proprietor. So who should be your addressee? That depends upon legal form of your client's organization. So for example's sake, as we are looking into this Reliance Industries Limited audit report, since it is a company, who is addressee here? Members or shareholders. So title has been given, then addressee has been given. So let us come to the next content. So once you have given title and addressee, let us come to the point first. Let us come to the point directly. So why we are giving audit report? So audit report is basically a document through which auditor expresses his opinion. So once you have given the title, once you have given the addressee, first come to the point directly. We will talk about the opinion. Finally, give the opinion what you are supposed to give on this financial statements which you have verified. Now we need to understand this opinion in a detailed manner. So basically, as per SA 705, so in order to have a discussion regarding opinions, now we are switching from SA 700 to SA 705. So let us try to understand the various kinds of opinion as given under SA 705. Then we will come to the next contents. So SA 705 says that opinion can be, auditor's opinion is broadly divided into two categories. Number one, unmodified opinion, and the other one is modified opinion. Auditor's opinion can be broadly divided into two categories, unmodified opinion and modified opinion. Now what is unmodified opinion? What is modified opinion? Let us try to revise them. Modified opinion, unmodified means simply a positive opinion. Unmodified means simply what? A positive opinion, which means you have verified the financial information of the client. You did not find any material misstatement. You did not find financial statements to be misleading. That means financial statements are giving true and fair view. So as an auditor, when you are satisfied by obtaining audit evidence that the financial statements of the company are giving true and fair view, they are not misleading, they are properly presented, then I will give unmodified opinion. Nothing but in common terminology, in common parlance, positive opinion, clean opinion we are giving. And if they ask you to write the definition of unmodified opinion, what you are supposed to write is, auditor will give unmodified opinion when the auditor is satisfied that yes, financial statements are prepared as per applicable financial reporting framework, and also auditor is satisfied that financial statements are free from material misstatements. So when the auditor obtained audit evidence and on the basis of that evidence, auditor is satisfied that yes, financial statements are prepared as per applicable financial reporting framework and also the financial statements are free from material misstatements, then the auditor will express an opinion called unmodified opinion. There are even other names for unmodified opinion. We can even call it as unqualified opinion, or alternatively we can call it as clean opinion also. What we can call unmodified opinion is having other names. It can also be called as unqualified opinion, or even it can be called as clean opinion. And the standard says that if you want to give unmodified opinion, you cannot use your own terminology. The standard has even given the prescribed terminology, prescribed sentences or phrases which you are supposed to use. So the standard says that in case if you are giving unmodified opinion, use the terminology, use any one of the terminology, either use the terminology financial statements give true and fair view, or alternatively use the terminology financial statements present fairly in all material respects. Financial statements present fairly in all material respects. So either use any of these phrases, that's all. Don't use your creativity and draft new sentences. When you want to give unmodified opinion, you have to use one of these two phrases. Either you have to say financial statements give true and fair view, or alternatively you can say financial statements present fairly in all material respects. Only one of these two phrases you have to use it. So the moment you find these phrases, any of these phrases in the auditor's opinion paragraph, that opinion is what opinion? Unmodified opinion. So this is what the definition of unmodified opinion. Now, when modified opinion will be given? So, see, if unmodified opinion is given when auditor is satisfied that financial statements are giving true and fair view. When modified opinion will be given is when the auditor is not satisfied with the true and fair view. When the auditor found that financial statements are a bit misleading. When the auditor found that financial statements are not presenting fairly all material respects. So, if the auditor is not satisfied with true and fair view, then auditor will give modified opinion. And this modified opinion will be of three different categories. Number one, qualified opinion. Number two, adverse opinion. And number three, disclaimer of opinion. So whenever auditor is not satisfied with the true and fair view, the auditor will modify the opinion. He will give a negative comment in his auditor's opinion, and that modified opinion can be given in three ways. That those are qualified opinion, adverse opinion, disclaimer of opinion. Now let us try to understand when auditor will give qualified opinion, when auditor will give adverse opinion, when auditor will give disclaimer of opinion. That we will try to have a quick revision now. So first we will talk about qualified opinion. First we will talk about qualified opinion. So the auditor will give qualified opinion in two circumstances. Auditor will give qualified opinion in two circumstances. Number one, when auditor has obtained sufficient and appropriate audit evidence. When the auditor has obtained sufficient and appropriate audit evidence, and on the basis of that evidence, auditor concluded that financial statements contain misstatement. So auditor has obtained sufficient and appropriate audit evidence, and on the basis of that evidence, auditor concluded that financial statements contain a misstatement which is material. Which is what? Material. It is big. There is a misstatement which is material enough, but the misstatement is not pervasive. Misstatement is what? Not pervasive. So you have performed audit procedures. After performing audit procedures, you have obtained audit evidence, and on the basis of the audit evidence, you have concluded that financial statements contain a misstatement, and the effect of misstatement is material. It is big enough, but it is not pervasive. It is not so big enough to say entire financial statements are wrong. Then the auditor will give qualified opinion. Like if I give you one example to make you understand this, assume I am conducting audit of financial statements of company, extract of the balance sheet I am giving. So the balance sheet details are something like this: fixed assets 200, current assets, the total of current assets like inventory, reserves, trade receivables, cash and cash equivalents. Those are also some details are given like 50, 50 and 50. So total of the balance sheet is 350. There are some liabilities also. Even when I verify liabilities, the total also here is 350. The place only where the balance sheet will not match is our exam. Balance sheet will always match in our real life. So this is what the extract of the balance sheet. Now I started performing audit procedures on this balance sheet. When I verified fixed assets, I found sufficient and appropriate audit evidence. No, nothing misstated. All the fixed assets are perfectly fine. I verified trade receivables. Here also everything is fine. I did not find any misstatement. I verified cash and cash equivalents. No misstatement. Similarly, I verified equity and liabilities. There also I am not able to find out any material misstatement. But when it comes to inventory, I am able to find a misstatement here. When I perform audit procedures in the inventory area, here I am able to find out misstatement. And the amount of misstatement which I have found is 5 crore rupees. How much misstatement I have found? 5 crore rupees of mistake. I was able to find it in the area of inventory. In rest of all the items, I did not find any material misstatement. Rest of all the items are giving true and fair view. So this is a case where auditor is having sufficient and appropriate audit evidence. Is the evidence available? Yes. And on that basis, auditor concluded that there is a misstatement. Is there a misstatement? Yes. How much misstatement? 5 crores. Is it material? Yes, it is material. Why? Because in 350 crores, 5 crores is somewhat material. It could influence the decision of users of financial statements. But is it so big enough to say entire financial statements are wrong? Which means on the basis of 5 crores, can we say entire financial statements are wrong? No. That means it is material, but it is not so big enough to say entire financial statements are wrong. That means it is not pervasive. So since auditor has obtained sufficient and appropriate audit evidence, on the basis of that, he concluded that financial statements contain a misstatement. The effect of the misstatement is material, but it is not pervasive. I will tell you in a short while what is the meaning of the term pervasive. We will try to understand it in a short while. So in this case, what opinion auditor will give? Qualified opinion auditor will give. Clear everybody? So one case I have told in which qualified opinion will be given. And there is one more case in which qualified opinion also can be given, which is auditor unable to obtain sufficient and appropriate audit evidence. As an auditor, you are unable to obtain sufficient and appropriate audit evidence, and the possible effect of that undetected misstatements is material but not pervasive. It will look somewhat similar to the previous case only, but the difference here is, in the previous case, auditor was able to obtain sufficient and appropriate audit evidence, but in this case, auditor is unable to obtain sufficient and appropriate audit evidence. Like if I give you example for this, we will take the same kind of example, but little bit change in the observations. Assume I am conducting audit of this particular company. Here also I have started performing audit procedures. I verified fixed assets, no misstatement. I verified trade receivables, no misstatement. I verified cash and cash equivalents, no misstatement. I verified equity and liabilities, no misstatement. But in inventory, I am not able to verify 5 crores worth of stock. In the previous case, I told auditor found a misstatement by verifying it. But here what I am telling is, I am not at all able to check the stock only. I am not able to verify the stock worth 5 crore rupees. I am not able to verify. So I am not in a position to obtain sufficient and appropriate audit evidence. Out of 50 crores, 5 crores worth of stock, I am unable to obtain audit evidence. Now, if this 5 crores worth of stock, which I am not able to get the evidence, if it goes wrong, what will be the impact? Will it be material? Yes. See, that's why I use the term possible effect. So whenever you are using the terminology unable to obtain audit evidence, you can't directly say effect of the misstatement. You have to use what? Possible effect of misstatement. Sir, why possible effect of misstatement, sir? Just a minute. Why possible effect, sir? Why? Because you are unable to obtain audit evidence. So we are just assuming what could happen if that item goes wrong. So I am not able to obtain evidence regarding 5 crores worth of stock. If this 5 crores, even if it goes wrong also, the possible effect is material. It is significant, but it is not so big enough to say entire financial statements are wrong. It is not pervasive. So qualified opinion can be given in two cases. Either you have a evidence or you don't have a evidence. But the effect or possible effect of the misstatement should always be only material but not pervasive. Clear everyone? So there is even a terminology. When you want to give qualified opinion, you have to use a terminology something like this. There is some dedicated terminology which you are supposed to use. Sir, how to identify the opinion is a qualified opinion? By looking at terminology. So what terminology auditor should use? Auditor should use a terminology except or subject to certain items that I will explain. What are those items? Except or subject to certain items, financial statements give true and fair view. Financial statements give what? True and fair view. That means there are just one or two items which contain material misstatement. Apart from that, rest of all the items are giving true and fair view. So if you find this particular terminology, except or subject to certain items, financial statements give true and fair view. That is what qualified opinion means. Now, can you call this as completely positive opinion? By using this sentence, am I giving completely positive opinion? No. Why? Because I am saying some items are there, no, which are materially misstated. So that's why it is not a completely positive opinion. At the same time, it is not a completely negative opinion. It is a moderate negative opinion. Clear? So whenever you find this terminology, except or subject to certain items, financial statements give true and fair view. That opinion, we call it as what? Qualified opinion. This is how to identify the qualified opinion. Understood? So qualified opinion, we have revised two circumstances in which qualified opinion will be given. Now let us try to understand when adverse opinion will be given. See, adverse opinion will be given only in one case, and that case is auditor is able to obtain sufficient and appropriate audit evidence. Auditor is able to obtain sufficient and appropriate audit evidence, and on the basis of that audit evidence, auditor concluded that financial statements contain a misstatement. Financial statements what? Contain a misstatement, and the effect of the misstatement is material, and it is not just material, it is even pervasive also. That means I conducted audit of financial statements. I have obtained audit evidence, and those evidences are saying that financial statements contain a misstatement. That misstatement is not just material; it is so big enough to say financial statements are completely wrong. So when I have evidence and I have concluded that financial statements contain a misstatement, the effect of the misstatement is not just material; it is even pervasive also. Then I will give adverse opinion. Sir, what kind of terminology should be used in the adverse opinion, sir? The terminology which the standard is suggesting you is directly saying the opinion paragraph, financial statements do not give true and fair view. What terminology we have to use in opinion paragraph? Straight away in the opinion paragraph we have to say financial statements do not give true and fair view. Don't believe this financial statements. Financial statements are completely wrong. So that's what the adverse opinion, completely negative opinion. And when it will be given? When you have sufficient and appropriate evidence available, and on that evidence you have concluded that financial statements contain a misstatement whose effect is not just material, it is even pervasive also. And what terminology I have to use? Financial statements do not give true and fair view. Then comes the last kind of modification, which is disclaimer of opinion. Which is what? Disclaimer of opinion. Sir, when disclaimer of opinion will be given? So it is also given in one case when auditor is unable to obtain sufficient and appropriate audit evidence and the possible effect of that undetected misstatements. That means those items which you are unable to obtain audit evidence, if they go wrong, the possible effect will be not just material, it is even going to be pervasive also. That means you are not able to obtain evidence regarding so many items, and if all that items goes wrong, the effect will not be just material, the effect will be pervasive. So in that case, auditor will give disclaimer of opinion. And the terminology which auditor should use in case if he is giving disclaimer of opinion is, he should use the terminology, we are unable to express an opinion on financial statements. The moment you find this terminology, that is what kind of opinion? Disclaimer of opinion. Clear everyone? So one last time I am repeating, qualified opinion. What terminology will be there? Except or subject to certain items. Financial statements give true and fair view. Adverse opinion, completely negative. I will say financial statements do not give true and fair view. Disclaimer of opinion, I will use a terminology, we are unable to express an opinion on financial statements. Why? Because we are unable to obtain evidence regarding those matters which are material and pervasive. Clear? Qualified opinion will be given in two cases, adverse opinion will be given in one case, disclaimer of opinion will be given in one case. Understood everybody? So that is what three kinds of modified opinion are, and these three kinds of modified opinion are actually explained in essay 705. Whatever different kinds of modified opinion which I have explained you, everything has been explained from which standard? From essay 705. So let me take you there. So if you go to essay 705, the title itself is modifications to the opinion in the auditor's report. That means this standard is talking about how to modify the auditor's opinion in the auditor's report. And as I have told, there are three different kinds of modified opinion. Number one, qualified opinion, which can be given in two cases. Number two, adverse opinion, which will be given in one case. And number three, disclaimer of opinion, which also will be given in one case. Now, we need to define modified opinion in such a manner that it takes into its perspective qualified also, adverse also, disclaimer also. See, modified opinion, three categories are qualified, adverse, disclaimer. Now we need to even define this modified opinion, no? And we need to define modified opinion in such a manner that under its definition, it will consider qualified also. Under its definition, it shall include adverse also. Under its definition, it should include disclaimer also. So let us see how the term modified opinion has been defined so that it will take into its perspective all the three different kinds of modified opinions. So if you have a look at it, the auditor shall modify the opinion in the following circumstances. When the auditor concludes that based on audit evidence obtained, that means auditor has obtained sufficient and appropriate audit evidence, and on that basis he has concluded that financial statements are not free from material misstatements. So as an auditor, you had evidence, and on that basis of evidence, you are concluding that financial statements are not free. That means financial statements are containing some material misstatements. In this case, which kind of modification will be given? In this case, either qualified or adverse will be given. Sir, why qualified or adverse, sir? Why? Because since you have evidence, and if you concluded that financial statements contain misstatement, which is only material but not pervasive, then I will give qualified. In case if I have concluded financial statements contain a misstatement which is material and also pervasive, then I will give adverse. So first point will take into its perspective qualified as well as adverse. Or we will modify the opinion when the auditor is unable to obtain sufficient and appropriate audit evidence. As an auditor, you are not able to obtain sufficient and appropriate audit evidence to conclude whether the financial statements are free from material misstatements. That means you are unable to obtain audit evidence. In this case, which opinion will be given? In this case, either qualified or disclaimer will be given. Why? Because this is a case of non-availability of audit evidence. So either qualified or disclaimer will be given. And B point, if you observe here, factors which are helpful in deciding which type of modified opinion will be given. Whether you have to give qualified, whether you have to give adverse, whether you have to give disclaimer, that depends on what circumstances. Simply, if you ask me, two circumstances will decide which kind of modified opinion will be appropriate, and those two circumstances are availability or non-availability of audit evidence. Number two, pervasiveness of the misstatement. If you observe all the three definitions, whatever I have told, either qualified, adverse, disclaimer, which kind of modification has to be given, that depends on only two circumstances. One is availability or non-availability of audit evidence. Other one is pervasiveness of the misstatement. Depending on these two things, we will decide whether qualified will be appropriate, adverse will be appropriate, or disclaimer will be appropriate. And one more important thing from SA 705, definition of the term pervasive. Definition of the term pervasive. Sir, you are saying misstatement, pervasive misstatement you are saying, but what exactly is the meaning of the term pervasive? Very important from the examination perspective. So the term pervasive misstatement can be defined as, we call a misstatement as pervasive. We call a misstatement is having pervasive effect when the misstatement is not confined to one or two elements of financial statements. That means a misstatement is not just restricted to one or two items of financial statements. It is spread across all the items of financial statements. That means misstatement is there in so many items of the financial statements, that we call it as pervasive. Or even though if the misstatement is confined to a specific item, it is representing substantial portion of the financial statements. Sometimes misstatement will be restricted to only one item, but the amount which it is representing is so big enough to say entire financial statements are wrong. Like for example, assume if I have taken a balance sheet, so many items are there in the balance sheet. If the misstatement is there in all the items, if the misstatement is spread across so many items, then we call it as pervasive. Or sometimes what will happen is misstatement will get restricted only to one item. Take for example, fixed assets, 100 crores are there. Misstatement is there in only 100 crores of these fixed assets, and the amount of misstatement is 80 crores. Here the misstatement is restricted only to one item, but it is representing a very big portion of the financial statements. The total of the balance sheet itself is 20. Out of that, in the fixed assets alone, 80 crores of misstatement is there. So even if it is confined to one or two items, but if it is representing substantial portion of financial statements, then also we call it as pervasive. Or if the management has made mistake in those kind of disclosures which are fundamental to users' understanding of financial statements, then also we call it as pervasive. If the management made a mistake in those kind of disclosures in the notes to accounts, the management has given such a wrong explanation in those notes which are very fundamental to users understanding of financial statements, like management made some wrong disclosure regarding going concern. Since it is very fundamental to users understanding, that misstatement also will be called as pervasive. So this is how the term pervasive has been defined. Even I have given definition here regarding the term pervasive. So if you observe, if it is not just confined to specific items of the financial statements, even if it is confined, it could represent a substantial portion of the financial statements, or in relation to those disclosures which are fundamental to users' understanding of the financial statements. So with this, we are done with different kinds of opinion, and along with that, the definition of the pervasive also we have seen. From where we have come to this discussion, is we are discussing something about contents of the audit report. In that third content, we are discussing opinion. So we have seen how opinion will be divided. So whatever it is, depending on facts and circumstances, the auditor should express an appropriate opinion. But in addition to the opinion, some extra information also should come in your opinion paragraph. Not just opinion, in addition to the opinion which you are expressing, some other information also shall be presented in the opinion paragraph. Sir, what extra information should come in my opinion paragraph in addition to the opinion which I am expressing? So SA 700 says 5 things must come in your audit report in the opinion paragraph along with the opinion. What are they, sir? So number one, you have to identify the entity whose financial statements you are auditing. Nothing but I tell the name of the entity whose financial statements you are auditing. Number two, you have to mention a fact that financial statements have been audited. Mention one statement that we have audited the financial statements. Number three, identify the title of each statement. Nothing but explain what and all are titles of items of financial statements. Like you should say, financial statement contain balance sheet, P&L, cash flow statement, etc. And also, you should give reference to notes and summary of significant accounting policies. And finally, you should even give reference to date and period covered by financial statements. These 5 things must come in your opinion paragraph. So what are the 5 things which must come in your opinion paragraph? So the 5 things are: number 1, identify the entity. Tell the name of the entity whose financial statements you are conducting the audit. Number 2, state the fact that financial statements are audited. Give a description of title of the components of financial statements. Give a reference to notes and significant accounting policies. Number 5, give a reference to period and date covered by the financial statements. So for practical sake, if I have to show you all these 5 details, you'll be able to find it in this paragraph. Like if I take you through this paragraph, they are saying we have audited the accompanying standalone financial statements of Reliance Industries Limited. 2 things are covered here. One is name of the entity they are telling, even they are telling the fact that they have audited the financial statements, which comprises balance sheet, statement of profit and loss, statement of cash flows, statement of changes in equity. Nothing but title of the components of financial statements. And they include notes to the standalone financial statements and summary of significant accounting policies. Fourth point, reference to notes and significant accounting policies. Last one, date and period covered by financial statements. That is also given here. Financial statements as at March 31, 2022. So these 5 items must come in your opinion paragraph. Clear? So successfully we are done with the third content, opinion paragraph. Now once the opinion paragraph is over, the next content which should come in your opinion, which should come in your audit report is basis for opinion. Now what information will be presented in the basis for opinion paragraph? SA 700 says 4 things must come in your opinion paragraph. 4 things must be presented in the opinion paragraph. So what are that 4 things which must be presented in the opinion paragraph is: number 1, you have to say that you are doing the audit as per standards on audit. You should mention you are doing the audit as per standards on audit. Number 2, state that you are independent of the entity and you comply with ethical requirements. Number 3, give a reference to auditor's responsibilities paragraph. Number 4, even you should mention whether evidence which you have obtained is sufficient and appropriate audit evidence. So in your basis for opinion paragraph, 4 things must be stated in the basis for opinion paragraph. What are the 4 things which must be stated? So here I have given detailed description. Number 1, mention that you are doing the audit as per standards on audit. Number 2, you have to give reference to auditor's responsibilities paragraph. Number 3, state that you are independent of the entity and you comply with ethical requirements. Number 4, state whether auditor believes that audit evidence which auditor has obtained is sufficient and appropriate. So even in the audit report also, if you do the detailed reading, that's what the 4 items which will be presented in the basis for opinion paragraph. Clear everybody? Now one more point to add here. SA 700 and 705, if you do a collective reading, they say that if you are giving unmodified opinion, the title of opinion paragraph will remain just opinion and the title of basis for opinion will remain just as basis for opinion paragraph when you give unmodified. But whenever you are giving modified opinion, either that could be qualified adverse disclaimer, the titles of opinion and basis for opinion paragraph also should be changed. So what I am trying to say is, in case if you give qualified opinion, the title of opinion paragraph should not be just opinion. The title of opinion paragraph should be qualified opinion. And the basis for opinion paragraph title should be changed to basis for qualified opinion. Similarly, if you give adverse opinion in the audit report, the heading of the opinion paragraph shall not be just opinion, it should be adverse opinion, and basis for opinion paragraph should be changed to basis for adverse opinion. The same thing will happen even for disclaimer also. Opinion paragraph heading should be disclaimer of opinion and basis for opinion paragraph should be changed to basis for disclaimer of opinion. But in case if you are giving unmodified opinion, the opinion paragraph heading will just remain opinion and basis for opinion will just remain basis for opinion. If you see the practical reports here, auditors of Reliance Industries Limited are giving unmodified opinion. That's why they have just given the title as opinion here and basis for opinion also has been given as just basis for opinion. In case if the auditors would have given modified opinion, they would have changed the titles of opinion and basis for opinion paragraphs appropriately. And in addition to that, in case if you give modified opinion, in the basis for opinion paragraph, along with these 4 things, some extra information also should come. If you give unmodified opinion, basis for opinion paragraph will contain only these 4 matters. But in case if you give modified opinion, that could be qualified adverse disclaimer, whatever it is. In case if you give modified opinion, along with these 4 matters, even you should mention in the basis for opinion paragraph, what are the reasons why you are giving modified opinion. If you give, once again I am repeating, if you give unmodified, only these 4 things will come in basis for opinion. If you give modified, along with that 4 things, few more information also should come in basis for opinion paragraph. What is that? The reasons why you are giving modified opinion, be that qualified, be that adverse, be that disclaimer, the reasons why you are giving modified opinion, that reasons also should be stated in the basis for opinion paragraph. And wherever possible, you should quantify the amount of misstatement. That means you have to calculate the amount of misstatement. That figure should be stated in the basis for opinion paragraph. In case if you are unable to quantify, mention the same thing that you are unable to calculate the figure exactly. Understood? So if you modify your opinion along with these 4 things, even tell the reasons why you are giving modified opinion. Clear everybody? So with this we are successfully done with the 4th paragraph also, which is basis for opinion paragraph. The next paragraph is about material uncertainty relating to going concern. So material uncertainty relating to going concern is a paragraph which will come as a part of SA 570. When we revise the standards on auditing regarding SA 570, then you will get to know what is this material uncertainty relating to going concern paragraph. So there it will be covered. But just remember here, as a part of contents of audit report, even one paragraph relating to going concern also will come in our audit report. So ignore this for the time being now. This will be covered as a part of SA 570 in the standards on auditing. Now let us come to the next point, key audit matter. Now what is this key audit matter? So in order to understand this key audit matter, we have to go to the standard SA 701. Which is talking exclusively about communicating key audit matters in the auditor's report. So first we should define what is the meaning of the term key audit matter. So the definition of the term key audit matters is those matters which in auditor's professional judgment were of most significant while conducting the audit of financial statements. How the term key audit matters has been defined? those matters which in the auditor's professional judgment, that means auditor using his knowledge, experience and training, he should select a few matters which he feel it as very important in the audit of financial statements, and those matters we call them as key audit matters. Like if I take you through the definition of the key audit matters, I will take you through SA 700 and 701. Quickly, we will revise very simple standard. So how the term key audit matters is defined? Key audit matters are those matters that in the auditor's professional judgment were of most significance, most important in the audit of the financial statements of current period. And key audit matters are selected from those matters which are communicated with those charged with governance, which means that if you want to include certain matter in the key audit matter paragraph, first you have to communicate that matter with the those charged with governance, then only you have to include it in the key audit matter paragraph. So now what is the purpose of communicating key audit matters, sir? The main purpose of communicating key audit matter is to enhance the communicative value of the auditor's report. Nothing but to increase the information provided by the auditor's report. The industry felt that audit reports are all looking uniform, exactly same. Industry members felt that audit report is not providing any extra information. So in order to increase that communicative value, to provide more transparency about the audit, this key audit matter has been introduced. So if they ask you purpose, we have to write to enhance, to increase the communicative value of auditor's report. Next one. So communicating key audit matters provide additional information to the users in addition to the opinion, etc. If you give the key audit matters, that will provide extra information to the users of the financial statements so that they can comfortably understand how the audit has taken place. In addition to that, few more things here. This is very important. Communicating key audit matters is not a substitute for three things. Communicating key audit matters is not substitute for three things. Number one, communicating key audit matters is not a substitute for those disclosures which the management has to give in the financial statements as per applicable financial reporting framework. Communicating key audit matters is not a substitute for those disclosures which management is supposed to give in the financial statements as per applicable financial reporting framework. If I put it in simple language, see, management is required to give so many disclosures in the financial statements as per applicable financial reporting framework. Now, the client for whom you are doing the audit, that management has forgot to include some disclosures in the financial statements. Now they are coming to the auditor and asking, sir, we are supposed to give some disclosure, but we forgot to do it. Why don't you include them as a key audit matter? We forgot to give some disclosure in the financial statements. Anyhow, you will give the audit report. No, in that audit report, under key audit matter paragraph, you explain the disclosure which we are supposed to give. Can the auditor agree to that? Definitely not. Key audit matter paragraph is not introduced as a substitute for disclosure in the financial statements, which means the standard did not introduce key audit matter so that if the management forgets something, auditor will include it here. No, whatever disclosure which management has to give in the financial statements, that should be given in the financial statements only. The management cannot come and ask the auditor. Even if they ask, auditor can't include it in the key audit matter paragraph. So key audit matter paragraph is not substitute for those disclosures which the management is required to give as per the applicable financial reporting framework. Number two, it is also not a substitute for giving modified opinion. For example, if you found out a material misstatement, can you say, I will give an unmodified opinion and explain about that misstatement in the key audit matter? No. Key audit matter paragraph is not introduced as a substitute for modified opinion. You can't do it. If you are supposed to give modified opinion, you have to give modified opinion. You can't say, I will explain that in the key audit matter paragraph. It is not a substitute for modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph. If some information is required to be disclosed in material uncertainty relating to going concern paragraph, that information should be explained in that paragraph only. Auditor can't say, instead of explaining it in the material uncertainty paragraph, I will explain it in the key audit matter paragraph. No, the matter which has to go to material uncertainty paragraph, that will go there only. You can't use key audit matter paragraph as a substitute for that matter which is required to be disclosed in material uncertainty. And whatever key audit matters which are getting explained in the audit report, on any of the matter, auditor is not giving any separate opinion. Auditor is not giving any separate opinion on any of the key audit matter. He's just letting you know what difficulties he has faced during the audit. We should not consider the key audit matters. On the key audit matters, auditor is giving separate opinion. Like if you observe here in this audit report, there are some key audit matters given. Like first, auditors of Reliance Industries Limited, they are giving capitalization and useful life of tangible and intangible assets as a key audit matter. Does that mean auditor is giving separate opinion on this matter? No, auditor is not giving any separate matter. Just he's letting you know what is the significance of this matter. That's it. So auditor will not give any separate opinion on any of the key audit matter. Understood, everybody? So this is what regarding purpose. So when they ask you purpose, write two things. The main purpose is to enhance, to increase the communicative value of auditor's report, and it is not a substitute for three things: for disclosures which are required in the financial statements, for modified opinion, for material uncertainty relating to going concern, and auditor is also not giving any separate opinion on any of the matters stated therein. Next one, applicability. Sir, is the key audit matter required to be explained in each and every audit report? The answer is no. For the time being now, key audit matters are applicable only in case if you are conducting audit of listed entities. Sometimes your client might not be a listed entity, but some law or regulation may require you to communicate key audit matters. Then also you have to include. So in two cases, it is mandatory in case if you are conducting audit of a listed entity or if there is any law or regulatory requirement. In all other cases, the auditor himself will decide whether he wants to give key audit matter or he doesn't want to give key audit matter. That means in rest of the cases, it is choice. But in two cases, it is mandatory. In case if you are conducting audit of listed company, or even though if it is not a listed company, if some law or regulation is asking you to include key audit matter, then we will compulsorily include key audit matter. In rest of the cases, let the auditor himself decide using his professional judgment. Then presentation. So obviously presentation is whatever key audit matters you want to include it in a separate paragraph with the heading key audit matter. You have to include a separate section in the audit report, give a separate heading key audit matter, and in that paragraph, whatever key audit matters you want to explain, you explain it. And you have to use some introductory language. What introductory language? You have to use this language. Key audit matters are those matters that in the auditor's professional judgment were most significant. Nothing but definition of key audit matters you will write. And even you will say that these matters we have considered while doing audit of financial statements, and we do not provide a separate opinion. So as a caution, we tell it to the shareholder, boss, we are just highlighting this information. We are not giving any separate opinion. So this introductory language you have to use, then you can start explaining about that key audit matters. Now coming to the next point, how to determine key audit matters, sir? In the definition, the standard has simply told it depends on auditor's professional judgment. But standard should help out the auditor know from where he can go and select the key audit matters, or what factors he has to consider in determining key audit matters. That is also given here. The auditor should start looking for key audit matters from three areas. The auditor should start looking for key audit matters from three areas. From those areas which have a very high risk of material misstatement, as you could see, you could select the key audit matters from those areas where the risk is very, very high. Or you can select the key audit matters from those areas which involve so many management assumptions and estimates, like provisions, depreciation. These are the areas where so many estimates and assumptions will be made. These areas also can be selected as key audit matter. Or if there are any significant events or transactions that have occurred, like amalgamation, etc., that events also can be taken as a key audit matter. So as an auditor, you can start looking for key audit matters from these three areas. What are they? Areas where there is a high risk of material misstatement, those areas in which significant assumptions and estimates are there, or significant events or transactions that have taken place during the year. And also, in some cases, we should not communicate key audit matter. When, sir? The standard has straight away told that in case if you are giving disclaimer of opinion, you should not disclose the key audit matter. In case if you are giving which opinion? Disclaimer. If you are giving disclaimer of opinion, you should not communicate key audit matter paragraph in your audit report. Your audit report should not contain a paragraph called key audit matter. Why? Because if you are giving disclaimer of opinion, you are saying that you are not able to express an opinion. That means you are unable to do the audit. When you are unable to do the audit, how can you identify significant matters from the audit? So that's why in case if the auditor is giving disclaimer of opinion, you should not include a key audit matter paragraph. However, even though when you are not giving disclaimer of opinion, some matters shall not be communicated as a key audit matter. If you give disclaimer, there is no paragraph called key audit matter. But in some cases, even though you are not giving disclaimer, that means you are giving other kinds of qualified, adverse or unmodified, then certain matters should not be communicated as a key audit matter. Which one, sir? That means If you are not giving disclaimer, that means if you are giving unmodified qualified adverse, key audit matter paragraph will be there. But some items should not come in that paragraph. What are they? When law or regulation prohibits some matter to be disclosed, there is some restriction from the law or regulation not to disclose certain matter, those matters should not come. Similarly, the next point, if you observe, the auditor determines that the matter should not be communicated because of possible adverse consequences. The auditor feels that because of disclosing this matter as a key audit matter, it will have more negative consequences. Then also auditor will not disclose it. Finally, the matter is highly confidential or sensitive. If the information is very sensitive or confidential, then also auditor shall not disclose it as a key audit matter. So once again, I am repeating, when it comes to prohibition, when auditor gives disclaimer, don't include key audit matter. Even when you are not giving disclaimer, some matters shall not be disclosed as a key audit matter, which are going to be those matters which law or regulation prohibits. The auditor feels that will have adverse consequences, or the matter is highly confidential or sensitive. So this is what SA 701 is about. So successfully we are done with one of the content, key audit matters, in our audit report, and we have revised even SA 701 also. So let us try to proceed further now with remaining contents of the auditor's report. So if we go back to the SA 700 once again and have a look at remaining contents once. Yeah. So key audit matters we are done, SA 701 we are done. So now talking about the remaining two contents. One is regarding emphasis of matter paragraph and the other one is other matter paragraph. And in order to understand what is this emphasis of matter and other matter paragraph, we have to go to SA 706 now. Now let us try to understand what is this emphasis of matter paragraph and what is this other matter paragraph. So SA 706 will be talking about emphasis and other matter. So first we will talk about emphasis of matter paragraph. So what is the meaning of the term emphasis of matter? So if you literally go by the definition, the dictionary meaning of the term emphasis means to highlight. What is the definition meaning or definition meaning of the term? What is the dictionary meaning of the term emphasis? To highlight. So emphasis of matter paragraph is a paragraph which will be used in the audit report to highlight some information which is already presented or disclosed in the financial statements. So emphasis of matter paragraph is a paragraph which will be used in audit report to highlight some information which is already presented or disclosed in the financial statements. That means some information is there which is already presented or disclosed in the financial statements by the management, but you thought that that matter is very much fundamental to users' understanding of the financial statements. The matter which is already disclosed or presented in the financial statements by the management, and the auditor feels that that is very fundamental to users' understanding of the financial statements, then the auditor should highlight that in the emphasis of matter paragraph. Like if we go to SA 706 and read the definition of emphasis of matter paragraph, the same thing will be mentioned there also. Like if you see it here, emphasis of matter paragraph is a paragraph which is included in the auditor's report that refers to a matter which is appropriately presented or disclosed. Management has already presented or disclosed that in the financial statements, but in the auditor's judgment, it is very important for the user's understanding of the financial statements. Such matter, auditor will highlight it in the emphasis of matter paragraph. Sir, are there any examples of the circumstances which can be used as emphasis of matter paragraph? Yes. So the examples of circumstances which can be highlighted in the emphasis of matter paragraph could be, so some examples as I have given here: uncertainty relating to future exceptional litigation, nothing but some pending cases going on against the company. The company is going through some case. In case if the company fails the case, the consequences will be very huge. And the management, without their mistake, they have clearly explained that in the notes to accounts. So and so pending case we are going through, they have disclosed it in the contingent liability without their fault. So now can I give modified opinion? No. Why? Because management, without their mistake, they have disclosed everything in the financial statements. But this contingent liability, this pending litigation is so important for users' understanding of the financial statements. This is what I felt. So now I want to highlight this information in my auditor's report. The information is there, which is already presented or disclosed in the financial statements, but still it is fundamental to users understanding. I want to highlight it in my auditor's report, where I will highlight in the emphasis of matter paragraph. I will highlight. One more example, if there is any significant subsequent event that occurs between the date of financial statements and the date of auditor's report. Similarly, if any subsequent event happened, an adjusting event is there, so which has been adjusted in the financial statements, but I want to highlight this information to the shareholder. How can I highlight it? I can highlight it in the emphasis of matter paragraph. Similarly, if your client is applying, if the client is applying some accounting standard earlier than the effective date, early application of a new accounting standard that has a material effect on financial statements. Like ICI released one accounting standard and they expected the companies to comply with it from 1st of April 2023. But what your client has done is well in advance, 1 year before only they have started applying this standard. So this had some significant effect on financial statements. This you want to highlight it to the shareholder, where you will highlight emphasis of matter. Or a major catastrophe or calamity, some big fire accident happened, some floods have happened, some calamity, some disaster is there, because of which the company has faced a huge losses. These kind of information, if you want to highlight it to the shareholder, here also I can highlight it in emphasis of matter paragraph. So these are a few examples which can be highlighted in the emphasis of matter paragraph. So what are the 4 examples I have told? Pending litigations, subsequent events, early application of accounting standard, or a major catastrophe or calamity which has taken place during the year. Next, sir, what is the manner of presentation, sir? Very simple. Highlight that matter in a separate paragraph. Give a separate heading in the audit report, emphasis of matter paragraph, and in that you try to highlight the information. I don't know whether it is here or not. Yeah, in the Reliance Industries Limited audit report, it is there. So like as you could see, the manner of presentation here, it has to be included in a separate paragraph with the heading emphasis of matter paragraph. A separate heading should be given. Similarly, along with that, include in the paragraph a reference to the matter being emphasized and also relevant disclosures which are given in the financial statements. See, you are using emphasis of matter to highlight some information which is already there in the financial statements, no? So that's why in the emphasis of matter paragraph, even give reference where you can go and find that information. Like here, if you observe, the management has highlighted some information. The management has already given some disclosure in note number 32A of the financial statements. Now, as an auditor, you are highlighting that matter. So in the emphasis of matter paragraph, you should tell where you can go and find that information in the financial statements. Like if you read here auditor is saying, we draw your attention to note number 32A. That means auditor is indicating there is some information in note number 32A of the financial statements which auditor is expecting the shareholder to go and refer that matter. So that's why emphasis of matter paragraph should include a reference where that matter can be understood in a detailed manner in the financial statements. Like here the auditor is saying, please go and refer to note number 32A. See, if you have to give reference, first the matter should be already presented or disclosed in the financial statements, no? So that's why we say emphasis of matter paragraph is used to refer such information which is already presented or disclosed in the financial statements. And apart from that, you should include a line that you are not modifying the opinion because of this matter, you are just highlighting it. Why? Because some people might take it wrong that even with a good intention you try to explain some matter in the audit report, some shareholders might take it wrong. So that's why add one line that we are not modifying our opinion, just we are highlighting it. Like as you could see here auditors have told our opinion is not modified in respect of this matter. We are not modifying, just we are bringing it to your attention. That's all. And like the way key audit matter is not a substitute for 3 things, emphasis of matter paragraph is also not a substitute for 3 things. Same 3 things, whatever we have just now covered in 701, key audit matters is not a substitute for 3 things. Even emphasis of matter paragraph is also not a substitute for 3 things. What are that 3 things? It is not a substitute for those disclosures which are required in the financial statements to be made by management. It is not a substitute for giving a modified opinion when required. It is also not a substitute for material uncertainty relating to going concern paragraph. Clear? So this is what regarding emphasis of matter paragraph. And the other paragraph which SA 706 will deal about is other matter paragraph. So this is regarding emphasis, but SA 706 talks about one more paragraph which is other matter paragraph. Now when we use other matter paragraph, or what is the purpose of this other matter paragraph? Very simple. You are using emphasis of matter paragraph to highlight some information which is already presented or disclosed in the financial statements. On the other hand, if you want to bring to shareholders' attention some information which is not presented or disclosed in the financial statements, then we use other matter paragraph. As simple as that. That's all, as simple as that. So if emphasis you are using it for highlighting that information which is already presented or disclosed, other matter paragraph will be used to highlight that information which is not presented or disclosed in the financial statements. If I have to give exact purpose, basically we use other matter paragraph to explain about auditors' responsibilities, to explain about any extra responsibilities taken by the auditor, or to explain about any cut down of the responsibilities happened in the auditor's responsibilities. So auditor's responsibility related matters will be explained in other matter paragraph. Like for example, you are not the branch auditor, one separate person was appointed as a branch auditor, explain it in the other matter paragraph. Or there is also one more joint auditor, explain it in the other matter paragraph. So like that, responsibility related matters will be used in the other matter paragraph. That's all regarding emphasis of matter and other matter. And one more last point in the standard, they say that communication with those charged with governance. Before you want to include either emphasis of matter or other matter paragraph, first auditor should go and communicate that with those charged with governance. Sir, this matter I want to include it in emphasis. This matter I want to include it in other matter paragraph. First go and communicate with those charged with governance. Then only you can make use of emphasis or other matter paragraph in the auditor's report. Clear? So successfully we are done with the remaining the two contents of the audit report, emphasis of matter paragraph and other matter paragraph. And as a part of that, we have even revised the standard SA 706 also. Now let us pay attention to remaining contents of the audit report. Like if I take you back to the remaining contents of auditor's report. So here if we come, the next content in the audit report is responsibilities of management for the financial statements. In the audit report, you have to use a paragraph explaining about what are responsibilities of the management. And here also, four things should come in the responsibilities of management paragraph as per SA 700. Number one, you should mention that management is responsible for preparation of financial statements, that too as per applicable financial reporting framework. Number two, you should tell that management is responsible for implementation of internal controls. Number three, you should mention that management is responsible for making an assessment relating to going concern. Number four, you should mention those who are responsible or those who are looking after financial statement preparation. Nothing but that's what they say it as, those who are having oversight of financial reporting. Nothing but you should identify in the management responsibility paragraph who is looking after that preparation of financial statements. If the board of directors are taking care of the preparation of financial statements, I will mention the same thing, the responsibilities of management, those charged with board of directors are responsible for preparation of financial statements. So like that, who is having oversight, who is controlling that financial reporting process, that also I should identify and mention it in the responsibilities of management. That's all. So these four things must come in your management responsibility paragraph. What are the four things? Preparation of financial statements, a design and implementation of internal control system, making an assessment regarding going concern, and who are having oversight over financial reporting process. Now coming to the next paragraph, auditors' responsibilities for the audit of financial statements. Immediately after management responsibilities, you have to include one more paragraph in the audit report explaining about your responsibilities, nothing but auditors' responsibilities. So what I will try to mention in the what I will try to mention in the auditor's responsibilities, nothing but your overall responsibilities. Like you should say, as an auditor, I need to obtain reasonable assurance whether financial statements are free from material misstatements, and define what is reasonable assurance. Say that reasonable assurance is a high level of assurance but not absolute assurance. You should say that you need to obtain reasonable assurance whether the financial statements are free from material misstatements. That is also one responsibility. Mention that. Next, you have to mention when misstatement will be considered material. You should say that misstatement will be considered material only if it could influence the decision of users of financial statements. Let them know that you have to comply with standards on auditing. And also you mention your responsibility of maintaining professional skepticism and professional judgment. Tell them that you are required to verify the internal controls. Tell them you are required to check the consistency of accounting policies. You have to verify the reasonableness of accounting estimates. So like that, simply whatever your responsibilities are there, give a brief about your responsibilities in the auditor's responsibility paragraph. Like if you see here, extract I have given here, the objectives of the auditor are to obtain reasonable assurance. This point you mention. And as an auditor, you have to give the audit report that contains an opinion. And what is reasonable assurance? It is a high level of assurance but not guarantee. And misstatement can arise from fraud or error, and they are considered material only if they influence the decision of users of financial statements. And you need to exercise professional judgment. You need to maintain professional skepticism. You have to identify and assess risk of material misstatement. You need to understand about internal controls. You have to evaluate and appropriateness of accounting policies. So in simple, what and all are your responsibilities that you have to mention in the auditor's responsibility paragraph. The next content is reporting on other legal and regulatory requirements, which simply means apart from the standards on audit, if some law or regulation is putting some extra reporting requirements on the auditor, then the auditor will use this report on other legal and regulatory requirements to highlight what are those reporting requirements. Simply, if I have to give example, like just in the introduction of this chapter, I have told there are three reporting requirements under Companies Act on the auditor: 143 subsection 1, 143 subsection 3, and 143 subsection 11. Under these three sections, there are reporting requirements on the auditor. But under which paragraph of the audit report, auditor will comment on these reporting requirements? He will make use of this particular paragraph, reporting on legal and other regulatory requirements. So this paragraph will be used for the purpose of those reporting requirements apart from standards on auditing like Companies Act, Banking Regulation Act, etc. Then comes signature of the auditor. After giving all the contents, auditor's signature should be given, and how to sign it. So for that also they have given instructions, like you have to mention the name of the firm, firm membership number should be there. Along with that, on behalf of this firm, the name of the partner who is signing, his membership number also should be there. Clear everybody? So the audit report, while signing the audit report, the auditor should sign in his personal name, mention his personal membership number, tell the name of the firm also, and even give the firm's registration number also. So all these details should be given in the signature. And apart from that, date of signature, nothing but the date on which you are doing the signature, the date also should be mentioned, like the date on which you are signing the audit report. Along with that, place of signature also. Place of signature means simply the city at which you are signing the audit report. That place of signature also should be there. And then coming to the next point, last point, UDIN. So what is this UDIN number is, as you could see in the signature, there is some 18 digits of alphanumeric number given below the auditor's signature, which we call it as unique UDIN full form is unique document identification number. Nothing but in the recent times, forgeries and also some non-chartered accountants misrepresenting themselves as chartered accountants, they have started signing the document. They have started creating fake stamps of the auditor. They used to forge the chartered accountant signature. So these kind of scams have happened a lot. So in order to increase the reliability of the auditor's signature, ICA has brought up this concept called UDIN, which has to be mentioned on every audit report which auditor is signing. So nothing but this UDIN is like OTP. Like we get OTP when we authorize a bank transaction, no? Similarly, whenever auditor is signing any audit report, he will log into a website called UDIN portal. From there, he will generate this unique number, UDIN number, which will come as a OTP to his mobile number. And that UDIN number should be mentioned in the auditor's report. With this UDIN number, one can find out whether this signature is really done by this practicing chartered accountant or somebody else. So that can be verified through this UDIN number by going to the website called UDIN portal and all. So in order to increase the authenticity of the auditor's signature, ICA has come up with this innovative concept called UDIN, and it has made mandatory for all the documents signed by chartered accountants to contain this UDIN number. Clear? So these are all the contents of the audit report given in SA 700, and as a part of revision of these contents, we even revised 4 standards if you observe carefully. 700 contents we have seen, 705 modifications to the auditor's opinion, 701 communicating key audit matters, 706 emphasis of matter and other matter paragraph. So 4 standards we have successfully revised. Clear everyone? So now let us revise few other aspects which are left out from this particular chapter. Now we have one more last point to be revised from this SA 700, which is relating to evaluations. So if we complete that revision of the evaluations, with that all the 4 standards revision will be completed. Then we will start revising the reporting requirements as per Companies Act, that is 143 subsection 1, subsection 3, subsection 11, whatever those reporting requirements are there, that we will try to revise. So first let us complete that revision regarding evaluations. So SA 700 says that as an auditor, before you can express your opinion on the financial statements, you need to do 2 kinds of evaluations. Evaluations means nothing but analysis. So as an auditor, before you form your opinion on the financial statements, you need to do two kinds of evaluations, which are going to be number one, qualitative aspects evaluation, and the other one is specific evaluations. So let us try to understand what is this qualitative aspects evaluation and what is this specific aspects evaluation. First, coming to qualitative aspects, when I say qualitative, it is something referring to other than amounts and balances. As a part of our audit, there is no doubt we will analyze whether the amounts are correct or not, whether the balances are correct or not, whether the balance sheet is matching or not, calculated profit figure is correct or not. Yes, our audit involves hell a lot of quantitative matters, but audit doesn't involve only numbers and figures. Sometimes we need to evaluate qualitative aspects also. Other than amounts and balances, sometimes we need to analyze some extra things. Sir, what is that example of that qualitative aspects? One best example, if I have to give, accounting policies. See, if I am checking whether the client's accounting policies are correct or not, like if the client is following WDV method of depreciation or diminishing value. So when diminishing value method of depreciation will be appropriate when the usage of machinery reduces year after year. On the other hand, if the client is following SLM method of depreciation, when SLM will be appropriate when the expected pattern of consumption is uniform. So if I am checking this particular thing, whether accounting policy is appropriate or not, that is not a quantitative aspects. I'm not looking at figures and numbers, but instead I'm looking at something other than figures and numbers. So this kind of things we call it as qualitative aspects. So that's what they try to explain in this entire paragraph. While doing audit, we might find out so many areas where management will be doing so many assumptions and estimates. And sometimes while we are checking this accounting policies and all, we might find bias of the management in selection of accounting policies. Sometimes management will not be objective. They will try to show the bias when selection of accounting principles. Or even you might find lack of neutrality. You might find that management is not taking decisions in an unbiased manner. They are showing some partiality towards some accounting policies. So whenever you come across any bias or lack of neutrality in selection of accounting policies to that transactions, we should immediately become alert. Why? Because bias or lack of neutrality indicate that management is trying to do some manipulation. And even they are giving some examples of indicators of lack of neutrality. Sir, will I get any hint here? So here management might show bias in selection of accounting policies. To find it out, will I get any hints, sir? Yes. Some examples they have given, like selective correction of misstatements. You have taken to the client some 10 misstatements, 10 errors you have found. You went to the management and told, sir, I have found this 10 errors, please do rectify. But what management is doing is, out of the 10 misstatements, they are rectifying only 7, which has the effect of increasing the profits. The remaining 3 they are not rectifying because that will reduce the profits. Don't you think this is a clear indicator management is biased? Yes, management is biased here. Similarly, management is making wrong accounting estimates. They are showing bias in selecting accounting estimates. Like for example, a debtor is about to go bankrupt completely. When the debtor is about to go bankrupt completely, 100% provision should have been created. But what management is doing is they have created only 50% provision. Even after they came to know that debtor is about to go bankrupt and nothing is recoverable from his account. They should have created 100% provision, but management has created only 50%. This is also bias. So whenever you come across these kind of circumstances, that is a hint for you that here there could be management's bias or lack of neutrality in selecting accounting policies. That's all. Very simple, guys. A bit terminology will make this point complicated, but one simple way to remember it is write a few random points, like number 1, management will make use of so many assumptions and estimates. Number 2, as an auditor, when you verify, you might find bias or lack of neutrality. Along with that, they are telling you some indicators which will give hint to the auditor there could be bias. Number 1, selective correction of misstatements. Number 2, possible bias in selection of accounting estimates. That's all regarding qualitative aspects. Now coming to specific evaluation, specifically auditor needs to check something. See, here they have given some points, like if you read the specific evaluations, they will say whether financial statements are disclosing all the significant accounting policies or not, whether accounting policies are consistently applied or not, whether accounting estimates are reasonable or not, information should be clear and understandable, and even financial statements should give disclosure of all the information conveyed, and along with that, terminology used in the financial statements will be appropriate. So if you pay attention to these factors, this is nothing but more or less similar to question number 1, whatever we have revised in the nature, objective and scope of audit. So there we have seen something like points to be considered before expression of an opinion. These points more or less look the same. So you need not remember these separate points. You can write the points from nature, objective and scope of audit, points to be considered before expression of an opinion. So more or less same points are there here also. So with this evaluations also we have revised. This puts an end to the revision of all the 700 series of standards which are talking about how to prepare audit report. We have seen all the contents, different kinds of modification, key audit matters, emphasis of matter, other matter paragraph. So all the things we are successfully done with. Now we will try to proceed further with the reporting requirements under Companies Act, which are given under three sections: 143 subsection 1, subsection 3 and subsection 11. So first we will start with the reporting requirements under 143 subsection 1. There are 6 matters which are required to be reported under 143 subsection 1. So let us try to have a quick look at it. First point is regarding loans and advances made by the company. First reporting requirement under 143 subsection 1 is, as an auditor, you need to check loans and advances made by the company. Made by the company means given by the company to the others. So first point is talking about assets of the company. Your client has given loans and advances to others. If yes, if they are on the basis of security, whether they are properly secured or not, and on whatever terms and conditions those loans are made, are they prejudicial to the interest of the company or members? Are they harmful to the interest of the company or members? The terms and conditions on which the loans were given, are they harmful? Sir, when the terms and conditions will be harmful, like company has given loan without charging any interest, they have given loan without offering any without accepting any security, they have given loan without mentioning any repayment period. So these are the examples of terms which could be prejudicial to the interest of the members. So whatever it is, first point we need to verify loans and advances, whatever are there, which are given by the company, whether they are properly secured, and the terms on which they are made, are they prejudicial, are they harmful to the interest of the company or members. Second point is regarding whether transactions represented merely by book entries. Whatever transactions are there, which are there just by way of book entries. Sir, what are the examples of transactions merely by book entries? Provision entries, depreciation. These kind of entries are nothing but just book entries. So whether those transactions which are represented merely by book entries, are they prejudicial? Nothing but whatever provisions etc. are getting created by the company, the provision should be neither over reported, provision should not be under reported. Provisions depreciation should be calculated at exact figures, no over reporting, no under reporting should happen. So that's what we need to check in the second point, whether the transactions represented merely by book entries, are they prejudicial, are they harmful? Entries like provisions depreciation, are they harmful to the interest of the company? Third point, in case if your company is having shares, whether your client company sold the shares at a price less than purchase price. Third point, you need to comment whether your client is holding the shares of any other companies. If yes, whether your client has sold the shares at a price less than purchase price. Nothing but whether your client has sold the shares at a loss. Sometimes in the exam, they will try to confuse you. They will give market price, they will give fair value, all these things they will say. Like for example, one question they might ask you something like this. So they will say that your client company is X Limited. You are conducting audit of this company. This company is holding shares of some other companies. They have bought it at the purchase price of 100 rupees per share. Current market price is 90 rupees. But the company was able to sell it at 95 rupees. Tell whether this transaction is required to be reported under 143 subsection 1. Yes, it is required to be reported. Why? Because selling price is less than purchase price. What is the current market price? That is irrelevant. If you find that the company has sold the shares at a price less than purchase price, you are required to report it. However, this point is not applicable in case if you are conducting audit of a banking company or investment company. This reporting requirement, this particular point need not be reported in case if you are conducting audit of a banking company or investment company. In case if you are conducting audit of other than banking or investment company, then only you need to report on this matter. D point, you need to check whether loans and advances which are given by the company have been shown as deposits. Here also they are referring to loans and advances made by the company. Made by the company means given by the company. So whether your client has given any loans and advances, but instead of showing it as loans and advances, have they shown it as deposits? Find it out and report it here. Whether personal expenses have been charged to revenue. Nothing but whether the personal expenses of management and board of directors, they have been shown as a business expenses, that we need to find out and report. And the last one, where it is stated in the books and accounts of the company that any shares have been allocated for cash. That means if you came to know that your client has issued some shares for cash, if yes, whether cash has actually been received, and in case if the cash is not received, the position stated in the financial statements should be correct and not misleading. That means you should show correct position in the financial statements. Clear everyone? So these are the 6 matters. Number 1, loans and advances given by the company, whether they are properly secured and the terms and conditions are not prejudicial. Number 2, transactions represented by mere book entries are not prejudicial. Number 3, whether the company has sold the shares at a price less than purchase price. Number 4, loans and advances are shown as deposits. Number 5, personal expenses are charged to revenue. Number 6, whether shares have been allocated for cash, if yes, cash has been received or not. In case if cash is not received, position stated in the financial statement should be correct and not misleading. And one more point here, the auditor is required to report on the above 6 matters under 143 subsection 1 only if he gets negative remarks. If he gets positive responses, no need to specifically report on that matter. You need to report on any of the above 6 points only if you get negative responses. That's all. So these are the reporting requirements under 143 subsection 1. Now let us come to the reporting requirements under 143 subsection 3. Under 143 subsection 3, there are altogether some 9 plus 6, 15 reporting requirements are there. Let us see what are they. So there are very remote chances that this question will be tested in the examination. Why? Because as we know in the recent examination, the descriptive question will be tested either for 3 marks or 4 marks. So they might ask you 143 subsection 1, 6 points for 4 marks is fine, reasonable. But 143 subsection 3 is having altogether 15 points. So it will be unfair to expect, I say will ask you to write 15 points just for 4 marks or 3 marks. They will not ask you. So very remote chances of asking it, but we will try to quickly cover these points. So there are a few points which are required to be reported under 143 subsection 3. What are they? Number 1, as an auditor, did you obtain all the information and explanation which is necessary for the purposes of your audit? Whatever information you needed, whatever explanation you needed for the purpose of doing the audit, whether did you get all that information or not, that you have to comment. Number 2, whether in your opinion, proper books of accounts are maintained by your client. Did your client maintain proper books of accounts? And also, did you receive returns from branches? Number 3, in case if there is any separate branch auditor, whether the branch auditor sent his report to you and how you have dealt with that report. You are a principal auditor, one of the branches are audited by somebody else, some other branch auditor is there. If yes, whether that branch auditor has submitted his report to you and how you have dealt with that report. Number 3, whether the company, number 4, whether the company's balance sheet and P&L are in agreement with the books of accounts. Nothing but financial statements are matching with the books of accounts or not. Number 5, whether in the opinion the financial statements comply with accounting standards, whether financial statements are prepared after complying with the accounting standards or not. Next one, if you have any observation or comment on the financial transaction which have an adverse effect, which have a bad effect on the functioning of the company, you need to tell it here under this point number F. Nothing but if you find any financial transaction which is having any bad effect on the functioning of the company, that you need to report. Whether any director is disqualified from being appointed under 164 subsection 2. You need to even comment whether any of the directors of your client are disqualified. Sir, when the directors will be disqualified under 164 subsection 2, listen carefully. If any company did not file annual return or financial statements for 3 consecutive financial years with the ROC, then all the directors of that company will be disqualified for a period of 5 years. Not just in the company in which they are acting as directors. For any company, they can't get appointed as director for 5 years. So when the directors will be disqualified under 164 subsection 2, when a company did not file annual return or financial statements for 3 consecutive financial years, for 3 continuous financial years. If a company is not filing annual return or financial statements with the ROC, all the directors of that company will be disqualified for a span of 5 years. So I need to check and give a comment whether any directors of my client company are disqualified under section 164 subsection 2. Then if you have any qualification, reservation or adverse remark relating to maintenance of accounts, if you find any mistake in the books of accounts, that comment you have to give it here. Next, whether the client is having adequate internal financial control, whether your client company is having proper internal financial controls and whether those internal financial controls are operating effectively or not. On this also you need to give comment. However, there is one note point here. For some companies, internal financial controls are not at all applicable. Some companies don't need to have internal financial controls only. Which companies, sir? If it is a private company which satisfies the following conditions, either it is a 1-person company or small company, or a private company which is having a turnover of less than 50 crores as per audited balance sheet date, And also, if they are having turnover less than 25 crores at any point of time during the financial year, then those companies are not required to implement internal financial controls at all. So what are the companies exempted from internal financial controls? One-person company, small company, and a private company having a turnover of less than 50 crores, and also borrowings from banks and financial institutions shall not exceed 25 crores at any point of time. Those companies are not required to implement internal financial controls at all. Now, if you are conducting audit of such a company which is coming under this exemption, what you will do? I will mention the same fact that my client company is not required to not required to implement internal financial controls at all. So reporting requirement does not apply. This fact you have to mention. Now, under J point, there are actually 6 extra reporting requirements which were added over a period of time. So till now, under 143 subsection 3, we have seen point A to point I, 9 reporting requirements we have seen. Now this under clause J, there are 6 more additional matters are there which are required to be reported. Let us see what are they. Number one, whether the company has disclosed the impact, if any, of pending litigations on its financial position. So as an auditor, I need to comment whether my client company, whatever pending litigations are going on against the company, everything has been disclosed in the financial statements or not, either as a contingent liability or provision. See, in one of the past examinations, they have asked a question, true or false statements they have asked. The auditor is required to disclose the impact of pending litigations in the auditor's report. This is what the true or false statements tested in the exam. Listen carefully once again. The auditor is required to disclose the impact of pending litigations on the financial positions in the auditor's report. Do you agree with that? The answer is no. Why? Because 143 subsection 3 is not asking auditor to give disclosure. They are just asking auditor to check whether company gave the disclosure regarding pending litigations, that too in the financial statements. Hope you have paid that attention. The 143 subsection 3 not asking auditor to give disclosure regarding pending litigations. 143 subsection 3 is in fact asking auditor to check whether management gave the disclosure in the financial statements or not. That you need to check. Next one, second one, whether the company has made provision as required under any law or accounting standard for material foreseeable losses on long-term contracts. If your client company has entered into any long-term contract, and if they came to know that on that long-term contract they are going to make a loss, your client company should not wait till the completion of the contract to recognize the loss. They have to recognize it immediately. So whether your client created a provision for losses on long-term contracts or not, that you need to check and give a comment. Whether your client has made any delay in transferring the amounts which are required to be transferred to Investor Education and Protection Fund. Is your client company required to transfer any funds to IEPF? If yes, whether they have made any delay in transferring the money required to be transferred to IEPF. Fourth point, I will come to that later. Fifth and sixth point, I will explain now. Whether dividend declared or paid during the year by the company is in compliance with Section 123 of the Companies Act. Whether your client company has declared any dividend, if the client company has declared any dividend, if yes, whether that dividend has been declared as per Section 123 of the Companies Act. So Section 123 talks about this dividend in a detailed manner, whether the client company declared the dividend after complying with Section 123 of the Companies Act or not, that I need to check. And whether company in respect of financial years commencing on or after 1st April 2002, that is from 1st April 2022, the company should use such an accounting software which has the facility of audit trail. From 1/4/2022, the company, whether the company is maintaining such an accounting software which is having the facility of audit trail or not, and whether that audit trail feature should not be tampered during the year. So whether whether your client is using such an accounting software which has the facility to record the audit trail which has not been tampered, that you need to comment. Guys, fourth point is there here, but it will take a lot of time for me to explain. So what I will do is, in the YouTube, I have already uploaded a detailed video explaining about this extra reporting requirements under clause J. I have done a dedicated video on YouTube to a dedicated video of for some 20-30 minutes of time to make you understand this 6 reporting requirements separately under clause J. That description, that YouTube link, I will give it in the description below. You can watch it. Clear everyone? So let me show you once here itself. So if you go to my YouTube channel, you will be able to find it there. So just a minute, I will show you. So if you go to my YouTube channel here, so in my YouTube channel, I have already uploaded a detailed video just explaining about this extra reporting requirements under 143 subsection 3 clause J. So you could see here, this is what that particular video is. In this, I have explained in a detailed manner what are that reporting requirements under 143 subsection 3 clause J specifically. Even the link to this video, I will give it in the description below. You please do watch it. So this is what the reporting requirements under 143 subsection 3. So all together we'll come back to the marathon now. So definitely I will give the link to that video in the description below. So please do watch it. Very important. Why? Because this contain recent amendments and these points are not suitable for revision, because this one point only will take, in order to explain only this fourth point, it will take half an hour of time. So I have already put that effort and uploaded a video, and I will give it in the description below. Please go and have a look at it. So like this, under 143 subsection 3, we have total of 15 matters which are required to be reported. 9 plus 6, 15 matters are there which are required to be reported. But one more thing here, like I told you previously, the matters under 143 subsection 1 are required to be reported only if you get negative comments. But for 143 subsection 3, those 15 matters, whatever we have revised now, these 15 matters are required to be reported whether or not you have a negative comment or positive comment. Irrespective of the answers which you get, all the 15 matters are required to be compulsorily reported. But whereas 143 subsection 1 matters are required to be reported only if you get negative responses. 143 subsection 3, 9 plus 5, 16 matters, whatever we have revised now, those matters are required to be reported in all the circumstances, irrespective of your responses, whether you get positive response or you get negative responses. Clear? Now we are going to discuss the reporting requirements under 143 subsection 11, and these reporting requirements also have an other name which we call it as CARO. Company Auditors Report Order, one of the most important from the examination perspective. From the CARO itself, you can expect minimum 4 to 5 marks. You can expect it only from the CARO. So let us try to spend enough of time on revising this CARO reporting requirements. Totally, we have 21 clauses which are required to be reported under CARO. Let us have a quick look at it. Shall we do it now? Right. So my this file is getting a stuck bit. So what I will do is I will close it and reopen it once again so that it will stop getting stuck. Just give me a minute's time. Yeah. So we can resume our discussion. So we are going to revise now CARO 2020. And how many reporting requirements are there under this CARO? We have a total of 21 matters which are required to be reported under this CARO 2020. Before we can revise what are that 21 reporting requirements, first we will try to understand applicability. Listen, this applicability itself is so important that even in the recent examination also, if you observe, there is a question regarding applicability only. So such an important concept is this applicability related matter. So we will try to spend enough of time in understanding or revising this CARO applicability, and then we will spend significant amount of time on revising the reporting requirements. So first we will talk about applicability. See, CARO is actually an additional reporting requirement which is given by central government after consulting with NFRA, National Financial Reporting Authority. Now, this order is applicable for every company, including a foreign company. However, CARO is exempted for certain class of companies. CARO is exempted for certain class of companies. In case if you are conducting audit of certain companies, CARO will not become applicable for you. So what are they? So number one, banking company. If you are conducting audit of a banking company, CARO doesn't apply. If you are conducting audit of an insurance company, CARO does not apply. In case if you are conducting audit of a Section 8 company, non-profit making company, CARO will not apply. It will not get applicable even for 1% company and even a small company. And it is not even applicable for private limited company. It is not applicable for private limited company if the private limited company satisfies 4 conditions. Not any one condition. If the private company satisfies all the 4 conditions, then CARO will not become applicable. Once again, I am repeating, when a private limited company satisfies any one or all 4. When the private company satisfies all the 4 conditions given here, then auditor need not report on CARO for that company. So what are that 4 conditions? So if I list them out, the company, your client company, should not be a subsidiary or holding of a public company. Number 2, your client should not have paid up capital and reserves and surpluses exceeding 1 crore rupees as on balance sheet date. Your client should not have borrowings from banks and financial institutions exceeding 1 crore rupees at any point of time during the financial year. And your client company should have a turnover as per Schedule 3, including revenue from discontinuing operations, not exceeding 10 crores during the entire financial year. So if your client company is a private limited company and if it satisfies all these 4 conditions, then CARO does not become applicable. Now sometimes they have asked a practical question. They will give in the question, so and so company is there, which is a private unlimited company and which satisfies the conditions. CARO applicable or not applicable? They will give you in a question, like for example, even I have included it here for reference. So in this material is a very comprehensive material. We have I have personally put a lot of effort in redesigning and revamping all this material. So please do consider downloading it, and how to download it I have already told you in the description below. Yes. So this is how, assume this is somewhat a kind of examination question. CA Jayesh is appointed as auditor of KP Private Unlimited, a company registered under Companies Act with unlimited liability. For financial year 2020-21, the company had total revenue of 8 crores, which is less than 10 crores. Borrowings from banks and financial institutions is also within the limit of 86 lakhs. Paid up capital and reserves of 97 lakhs. Explain whether this audit report must include CARO. So now if you observe, look at the conditions, all the conditions are satisfied. So the company's turnover is less than 10 crore, borrowings from banks and financial institution is less than 1 crore, and even paid up capital and reserves and surpluses balance is also less than 1 crore. Now is the CARO applicable or not applicable? CARO will be applicable. Why? Because exemption is there for a private limited company subject to fulfillment of conditions. But in the given case, the client is a private unlimited company. Since the company is a private unlimited company, no need to check for any conditions. CARO will directly become applicable. CARO will be applicable. Exemption is there only for a private limited company subject to fulfillment of conditions. For a private unlimited company, no exemption, nothing, directly CARO will become applicable. So like this also they might pose you a question. So now let us try to understand these conditions in a detailed manner and special points that need to be kept in mind while doing this calculations. Let us try to do it. Sorry. Yeah. So what is the first condition here? First condition, they are saying that your client should not be a subsidiary or holding of a public company, which means if you are conducting audit of a private limited company, that private limited company should not have a holding company, which is a public company. The private company should not have a subsidiary company, which is a public company. Condition number 1, in case if your client company is a private limited company, for CARO to be not applicable, first condition is your client company should not have a holding company, which is a public company. Your client company should not have a subsidiary company, which is a public company. Condition number 1. Second condition, your client paid up capital and reserves and surpluses should not exceed 1 crore. That means it shall be less than or equal to 1 crore. Even if it is 1 crore is also fine, but paid up capital and reserves and surpluses shall not exceed 1 crore even by 1 rupee also. Now some special points to be kept in mind while doing the calculation. When I say paid up capital, equity share capital also will be considered, paid up preference share capital also will be considered. And when I say reserves and surpluses, all kinds of reserves will come here. Capital reserves will come, revenue reserves will come, revaluation reserve will come, and even statutory reserves like CRR, DRR, all these things will come. So all kinds of capital is required to be considered. All kinds of reserves and surpluses are required to be considered. Sometimes there will be a debit balance in the P&L account. If there is any debit balance in the P&L account, that could be adjusted again as a credit balance for the purpose of calculation of reserves. Like for example, assume reserves and surpluses credit balance is some 80, but there is a balance in the P&L. P&L debit balance is 20. So this 20 can be adjusted again as this 80. Sometimes what will happen is even after adjusting against the credit balance of the reserves, there will be excess debit balance left in the P&L account. If I give you one typical example, the company is having paid up capital of 120 lakh rupees. In the reserves and surpluses category, they have credit balance of the reserves, which is 20 lakh rupees, whereas they have a debit balance in the P&L of 50 lakh rupees. Now, out of this debit balance in the P&L, only 20 could be adjusted against the reserves. Even after that, 30 lakh rupees of excess debit balance is left out. Can this be adjusted against the paid up capital for the purpose of calculation? Yes, it can be adjusted. So, excess debit balance in the P&L can be adjusted even against the paid up capital also for the purpose of calculation of paid up capital and reserves and surpluses. So, these special things you have to keep in mind. Understood? Now, coming to the third point, borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Very important thing, at any point of time. Now, there are some special points which we need to pay attention here. Borrowings from only banks and financial institutions are required to be considered. Borrowings from individual person, all these things will not be considered. Borrowings only from banks and financial institutions will be considered. When I say borrowings, they could be short-term borrowings, they could be long-term borrowings. Every borrowing should be considered. And frankly speaking, even credit card outstanding amount is also required to be considered. All kinds of balances, short term, long term, every kind of borrowing, or even that could be secured, unsecured, every kind of borrowing you have to consider. And you should not see the borrowings amount only as on balance sheet date. At any point of time, the borrowings shall not exceed 1 crore at any point of time. During the year, even for one day also, if the outstanding balance of borrowings has exceeded 1 crore rupees, CARO will become applicable. Like for example, a typical example I will give you. 21-22 financial year, opening date 1/1/4/2021, borrowings from banks and financial institutions 70 lakh rupees. As on 30th of June 21, the company has taken additional borrowings of 40 lakh rupees. During the current year, the company repaid some borrowings to the extent of some 50 lakh rupees. As on the balance sheet date, that is as on 31st of March 2022, the closing balance is 60 lakh. CARO becomes applicable or not? Yes, it becomes applicable. Why? Because from 30th of June till 30th of September, the outstanding balance is 110 lakhs, which has exceeded 1 crore rupees. CARO becomes applicable at any point of time is very, very important. But when you are checking paid up capital and reserves and surpluses, you need not be concerned at any point of time. Paid up capital and reserves and surpluses balances shall not exceed 1 crore only as on balance sheet date. During the year, anything can happen, but paid up capital and reserves and surpluses balance shall not exceed 1 crore only as on balance sheet date. But for borrowings, at any point of time during the financial year. And few more things here. When I say borrowings, all kind of borrowings are required to be considered. This I have already told you. And one more thing here. This limit of 1 crore is for all banks and financial institutions put together. Collectively, the total borrowings from all banks and financial institutions shall not exceed 1 crore. It should not be like for each bank and financial institution 1 crore of limit. No. The cumulative balance of borrowings from all banks and financial institutions shall not exceed 1 crore. Not for individual banks separately 1 crore limit is given. Now, fourth point, the total revenue of the company shall not exceed 10 crores, should be less than or equal to 10 crore rupees. Now, while calculating this, the special points which you need to keep in mind is revenue from discontinuing operations also should be added. If in the question they are saying revenue from discontinuing operations, that shall be added for that revenue. And from this total revenue, only three things are permitted to be deducted. One is sales returns are to be deducted. If there is any trade discount, trade discount also can be reduced, and along with that, even GST or other tax components also can be reduced. But sometimes in the question they will give you something like this: total revenue of the company 11 crores, GST collected and accounted separately. They will ask you this also: GST collected and accounted separately 1 crore rupees. Now what you will consider for calculation? Will you consider the figure as 11 crore rupees, or will you adjust that 1 crore and consider it as 10 crore? You have to consider 11 crores only when you see the phrase GST collected and accounted separately. The meaning of this sentence, GST collected and accounted separately, is the given turnover does not include the GST component. That's what it meant. See, when the given turnover does not include GST component, why we will deduct it once again? So like this, if you find this terminology, GST collected separately, excise duty collected and accounted separately, that means that the given revenue figure is already exclusive of taxes. We should not reduce it once again. Clear? So these are the things which needs to be kept in mind while calculating total revenue. So keeping all these things in mind, we need to check for these limits in the case of a private limited company. And if all conditions are satisfied, then CARO becomes not applicable. If any of the condition is violated, then CARO becomes applicable. And one more thing, in case of holding company will prepare two sets of financial statements, standalone financial statements and consolidated financial statements. Limits will be calculated only as per standalone financial statements, not consolidated. And while conducting audit of consolidated financial statements, CARO is exempted except one clause, which is clause number 21. If you are conducting audit of consolidated financial statements, your audit report need not include the 20 clauses, only clause number 21 should be mentioned in consolidated financial statements. In case if the company is having branches, then the limits will be calculated for the company as a whole, including all the branches information. And once CARO becomes applicable for the entire company, all the principal auditor, branch auditor, everybody have to report on this 21 matters in their respective audit reports. Understood? So this is what calculations, applicability criteria. Very important, as I have told, sometimes questions will be tested from this applicability criteria itself. Now let us come to the reporting requirements. What are those 21 matters which are required to be reported? That we will try to understand. First reporting requirement is regarding property, plant and equipment. Regarding property, plant and equipment, you need to check 5 things. How many things? 5 things. Number 1, you need to check whether your client is maintaining proper records relating to fixed assets. Sorry, PPE. Whether your client is maintaining proper records relating to PPE, which should show quantitative details of PPE, situation of the PPE, nothing but location of the PPE. So whether your client is maintaining such a records, which should show me quantitative details as well as situation or location of PPE. Number 2, whether those fixed assets are physically verified by the management at reasonable intervals. Whether your client company has physically verified. They're not asking auditor to do physical verification. They're asking whether management did the physical verification of that PPE at reasonable intervals. Here at reasonable intervals means once in 3 years. For PPE physical verification, reasonable interval can be taken as once in 3 years. And on doing such physical verification, did the management find out any material discrepancy? Any differences were found out by doing that physical verification? If yes, whether they have been properly dealt with in the books of accounts, whether they have been properly adjusted in the books of accounts. So this is the second point regarding physical verification. First point is regarding maintenance of records. Second point is regarding physical verification. Number 3, we need to check titles of immovable properties. Nothing but whether your client is a true owner of the immovable properties or not, I need to check. Sir, how can I check the title of immovable properties? Simply by checking the registration documents, by checking the sale deeds. So whatever land and buildings are there in your client's balance sheet, get the registration documents of all these land and buildings, check whether in the registration document company's name is there or not. If company's name is not there, that means in the registration document, if somebody else's name is there, then I need to report some details. What are they? Description of the property, describe about that property, what is the gross carrying value. If not in the company's name, then it is held in whose name, whether that person in whose name the property is held, is he promoter, director or employee, for what period the company is holding, the asset, and the reason why it was not yet transferred in the name of the company. These reasons are required to be reported in case if the property is not in the name of the company. If it is there in the name of the company, no issue. Now, coming to the fourth point, during the year, whether your client company did any revaluation of the assets. Revaluation means restating the assets. In case if your client has done the revaluation of the assets, whether the revaluation is based on valuation done by a registered valuer. Whatever figure comes to your client's management should not be revalued. The company should go to a registered valuer, get the valuation certificate. As per that valuation certificate, revaluation should happen. So I need to check whether revaluation is based on a certificate from registered valuer. And also specify the amount of change. You need to mention how much amount of change has happened because of revaluation only if the change is 10% or more in the aggregate of net carrying values of each class of property, plant and equipment. Which means you need to tell the amount of revaluation only if because of revaluation the change is 10% or more. Not for individual asset, for aggregate value of entire class of assets. So what do I mean by here is, I will give you one best example to make you understand, very, very important. Assume company is having some buildings under buildings category. 3 buildings are there. Building 1, building 2, building 3. I will give you values before revaluation. I will give you values after revaluation. So before revaluation, the building 1 is having a value of 100 crore rupees. It was revalued to 115 crores. Building 2 is having a value of 50 crore rupees. It was revalued to 53 crores. Building 3 is having value of 100 crore rupees. It was revalued to 87 crore rupees. Now you tell me for which asset I need to mention the amount of revaluation. Will you say here, sir, here change is 15 crores, more than 10% before revaluation. 10% is 10 crores only. Revaluation is more than 10% here. Here only 3 crores of revaluation, less than 10%. Here 13 crores of difference of revaluation, which is also more than 10%. Will you say I will report the amount of change for building 1 and building 2? You are absolutely wrong. You are completely wrong. You are required to tell the amount of revaluation if the change is 10% or more, not for individual asset. If the change is 10% or more for the aggregate of entire class of PPE. For what? For aggregate of entire class of PPE. So what do I mean here? You need to check the value before revaluation or after revaluation for entire class of buildings, not for individual buildings. So if I do the totaling here, it will be before revaluation, entire buildings was 250 crores. After revaluation, the buildings value was somewhere around 255 crores. If I'm not wrong, correct me if I'm wrong with the calculations. So I guess so it is 255 crores. So there is, for the entire buildings category, there is only 5 crores of change because of revaluation, which is hardly less than 10%. Here 10% is only 25 crores, but the effect of revaluation is only 50 crores. No amount is required to be reported. Clear everybody? So fourth point is regarding revaluation, whether your client has revalued any of the property, plant and equipment. If so, whether that revaluation is on the basis of registered valuer certificate, and because of that revaluation, if the change is 10% or more, that too in the aggregate of total value of each class of property, plant and equipment, specify the amount of change also. Next, last point regarding PPE, whether any proceedings have been initiated or are pending against the company for holding Binami properties. Whether any case has been filed against your company, or whether any case is already going on against the company for holding Binami property. If yes, whether the company without hiding disclosed the details of that proceedings in the financial statements or not, that I need to comment. Once again, I am telling you here also, the CARO is not asking auditor to disclose the Binami transactions. The CARO is asking auditor to check whether management disclosed the Binami transaction cases in their financial statements. I'm repeating it once again. In this case also, the CARO is not asking auditor to disclose the Binami transactions in his audit report. They are just asking the auditor to check whether company disclosed the details of Binami transactions in their financial statements or not. Clear? So this is the first reporting requirement, PPE. Regarding that, 5 points are there. Number 1 is regarding proper record maintenance. Number 2, whether physical verification done by the management. Number 3, title of the immobile properties are held in the name of the company. Number 4, whether any revaluation happened. If yes, on the basis of registered valuer. If the change is 10% or more for each class of asset, mention the amount. Number 5, whether company disclosed the Binami transaction cases in their financial statements or not. That's all. This is the first point. Second point is regarding inventory. Regarding inventory, what I need to do? First, here also I need to check whether physical verification of inventory has been done by management, not auditor. They are not asking auditor to do physical verification. They are asking whether management did the physical verification of inventory at reasonable intervals. Here reasonable intervals means once in every year. For physical verification of inventory, reasonable interval means what? Once in every year. And whether the coverage and procedure of such verification is appropriate. Whatever coverage management has done, whatever procedure management has followed for doing that physical verification, is that appropriate or not? You have to give the comment. And whether any discrepancies, differences of 10% or more, here also for aggregate of each class of inventory were noticed. For every class of inventory, if you find difference of more than 10%, then you need to mention that amount, and also you have to tell whether it has been properly dealt with in the books of accounts. See, when I say classes of inventory, when it comes to inventory, there will only be 4 classes: raw material, work in progress, finished goods, stores and spares. So if there is 10% or more difference you are able to find for total of each class of inventory, then only you need to report that difference. If the change is there, but less than 10% discrepancy is there for entire class of asset, then you need not report that discrepancy. Next, working capital loans. Second point is regarding In case your client at any point of time during the year, whether your client has taken working capital loan in excess of 5 crore rupees, giving security of current assets. Second reporting requirement is applicable in case your client company has taken loans. That to which kind of loan? Working capital loan. That too for an amount exceeding 5 crores at any point of time during the financial year. And what they have given as security for this working capital loans? Current assets, mainly stock. So in case if your client has taken any working capital loan in excess of 5 crore rupees from banks or financial institutions giving the security of current assets, then I need to check whatever quarterly stock statements which my client company is submitting it to the banker, are they submitting genuine stock statements? That means are those stock statements are in agreement with the books of accounts of the company, or if they are submitting wrong stock statements to the banker, that also I need to check. So this particular point is included to protect the interest of the bankers. Clear everybody? So that is what the second point is about, whether your client has taken any working capital loan, that too in excess of 5 crore rupees at any point of time during the year. If yes, they will generally submit quarterly stock statements to the banker to make the banker aware of what is the current status of the stock. As an auditor, I need to check whatever quarterly stock statements which my client company is submitting to the banker, whether they are matching with the books of accounts. That is, whether they are submitting genuine stock statements or they are submitting fake stock statements. That I need to have a look and give a comment on that. Clear everybody? So 2 reporting requirements we are done. We are left with 19 more. So let us have a look at them now also. Now we will go to point number 3. So point number 3 is talking about investments, guarantees, security, loans or advances given by the company. So this third point is regarding loans and advances which are given by the company to others. That means this is also talking about assets of the entity, the loans which your client company has given to others. So now in this also 6 points are there. Let us try to understand them. First one, you need to find out whether your client company has given loans to any of the related parties. So third sub point we are dealing in that 6 points will be there. Point number A, you need to check whether your client company has given any loans and advances or investments or guarantees to any of the related parties. If yes, we need to segregate how much amount of loan was given, aggregate amount of loan given, and balance outstanding for subsidiaries, associates and joint venture. We have to report that separately. For other than subsidiary, associates and joint ventures, that I need to mention the amount separately. Whether your client has given loan to any of the related parties, if yes, I need to divide aggregate amount of loan given during the year, balance outstanding at the end of the year, for subsidiary, associate, joint ventures separately, for other than subsidiary, associate, joint venture separately. Like for example, the company has given loans of total 100 lakh rupees. Out of that, to total 10 entities the company has given the loan. Out of that, 4 subsidiary, associate, joint ventures are there. So the company has given total loan of 100 lakhs to 10 entities. Out of the 10 entities, 4 entities are having a relationship of subsidiary, associate, joint venture. Remaining 6 are other than subsidiary, associate, joint venture. Now I need to divide out of this 100 lakh rupees of loan, how much was given to subsidiary, associate, joint venture. Assume 60 lakhs was given. How much has been given for other than subsidiary, associate, joint venture? 40 lakh. Not just that, what is the balance outstanding as on the balance sheet date? So they have given loan during the year, but during there some repayments, all that things also would have happened. I need to even report what is the balance outstanding as at the end of balance sheet date from subsidiary, associate, joint venture. Assume it is 50 lakh rupees. And what is the balance outstanding for other than subsidiary, associates, joint venture? Assume it remained the same 40 lakh rupees. So like that, in case if my client has given loans to any of the related parties, I need to divide aggregate amount of loan given and balance outstanding for subsidiary, associate, joint ventures separately and other than subsidiaries, associates, joint ventures separately. Clear? Second point. This is the first point that I tried to summarize here. Second point, I need to check under whatever terms and conditions the loans are given, whether those terms and conditions, are they prejudicial, are they harmful to the company's interest. This point we have already covered under 143 subsection 3. They are saying you to check the same thing here also once again. Under whatever terms and conditions your client has given loans to that other parties, are those terms and conditions are genuine or are they harmful? I already gave you examples when the terms and conditions will be considered as harmful. When they will be considered harmful? So if they have been given without charging any interest, without repayment period, without any accepting of security, then they will be considered as prejudicial or harmful. Next, third point, it should not be like just your client has given the loan and ignored it. As an auditor, even I need to check whatever loans that have been given to others, whether repayment of principal and payment of interest is happening regularly on or before the due dates, whether your client, whether the third parties, whoever have taken the loan, whether they are repaying the principal and interest on or before the due dates or not, that also I need to check and give a comment. And if at all, any amount remains overdue for more than 90 days. If your client has given loan to other party and if the other party is not repaying the loan, if it has remained overdue and if it remains overdue for more than 90 days, I need to check whether management has taken reasonable steps for recovery of the principal and interest. Whether management, whether the company has taken reasonable steps for what? For recovery of principal and interest. What could be reasonable steps? Selling the security, filing a case on them, etc. Whatever it is, reasonable steps are taken by the management for recovery or not, I need to check. Then we have rescheduling or extension of the loans, which means your company has given some loan in the past and that loan has fallen due during the year. In the current year, the due date is there. When the due date is in the current year, your client should have collected the money. But instead of collecting the money of the loans which have fallen due, what your client is doing is they are either renewing it or they are extending it or the fresh loan is given to the same party to settle the old loan. Did you find any of these transactions? Your client has given loan in the past which has fallen due in the current year, but instead of collecting the loan which has fallen due, they are either extending or renewing it. That means they are extending the due date, or for the same party they are giving a new loan. Out of that new loan, he is repaying the old loan. Nothing but indirect way of extending only. So did you find whether your client has conducted these kind of transactions? Instead of collecting the loans, they are renewing, extending, or fresh loans are given to same party. If yes, I need to report what is the total amount of such loans which are renewed, extended, or settled by fresh loans. The total amount of loans I have to report. Along with that, I need to calculate percentage with the total loans and advances. Like for example, the total loans are 100. Out of that, 40 lakh rupees of loans are in the nature of renewal, extension, and fresh loans. So percentage, if you calculate, that will be 40%. That percentage also I need to calculate and report it here. Clear? However, this particular point is not applicable in case if you are conducting audit of such a company whose principal business is to give loans. Nothing but in case if you are conducting audit of banks and financial institutions, this reporting requirement does not apply. For banks, CARO itself will not be applicable. Even if you are conducting audit of any NBFC, then you are not required to report on this matter. Not just this point, even the first point also, this loans to related parties. I told you that segregation, aggregate amount and balance outstanding, that first point is also not applicable in case if you are conducting audit of such a company whose principal business is to give loans, whose main business is to give loans. That is, for banks and financial institutions, you need not report on this matter. And one more last point under this third point, whether your client has given any demand loans. Demand loans means your client is giving loan without mentioning any repayment period. So in case if you find out that your client is giving the loans without mentioning any repayment period, you need to mention in the audit report what is the total amount of such loans given without repayment period. Here also calculate the percentage, how many total loans are there, out of that how much percentage is in the form of demand loans, that calculate the percentage also. And along with that, tell how much amount has been given to promoters and related parties. Out of the total loans, how much demand loans are given to promoters and related parties, that also you need to mention. So coming to the third point, 6 sub points are there which we have seen. Number 1, in case if your client has given loan to related parties, divide between subsidiary, associate, joint venture other than subsidiary, associate, joint venture. Second point, whether the terms and conditions are prejudicial. Third point, repayment of principal and interest is happening regularly on or before due dates. Number 4, if amount is overdue for more than 90 days, reasonable steps are taken by the company for recovery of the principal and interest. Number 5, when the loan has fallen due, instead of collecting it, whether your company has renewed, extended, or fresh loan given to same party. If yes, mention the total amount and also calculate the percentage. Last one, whether your client has given loan without mentioning any repayment period. This is what we call it as demand loans. If yes, mention the total amount of such demand loans. Here also calculate the percentage and report it. That's all. This is what the third reporting requirement. Now coming to the fourth one, very simple. Fourth point is also regarding loans, investments, guarantees which are given by the company. In the fourth point, they simply says that if your client has given any loan, investment or guarantee to other parties, check whether they are giving it after complying with the section 185 and 186 of the Companies Act. That's all. Fifth point, acceptance of deposits. In case if your client company has accepted deposits, whether they complied with section 73 to 76 of the Companies Act, and regarding that acceptance of deposits, if there are any directives or instructions given by RBI, whether they are complied with or not, and if there is any order of CLB, that is Company Law Board, court or tribunal regarding that deposits, whether those are complied with or not. Very simple. In case if your client has accepted any deposits, provisions of the Companies Act, RBI instructions, court order, whether all these are complied with or not, I need to check. If you find any non-compliance, report what is that non-compliance which has happened during the year. Next one. Sixth point, maintenance of cost records. Nothing but whether your company is coming under that applicability criteria given under section 148 subsection 1. If yes, whether your client is maintaining cost records or not. That's all. Whether for your client cost records are applicable. In case if cost records are applicable, whether your client is maintaining proper cost records or not, you have to comment on that. Next, seventh point, important point, which is regarding statutory dues. First of all, what is the meaning of statutory dues? Statutory dues means those amounts which are required to be paid because of the requirement of law. You are required to pay some amount because of requirements of law. Examples, income tax, GST, PF, ESI, gratuity. So these all will come under statutory dues. And regarding the statutory dues, there are some reporting requirements. And for the purpose of auditors reporting requirements, statutory dues are divided into two categories, undisputed and disputed. So what is this undisputed and disputed? Disputed dues means there is some case going on between your client company and the regulatory authority. That's why some tax amount was not paid. That is disputed. Undisputed means there is no issue, nothing, no one is challenging. So, but still your client did not pay the money. That is undisputed. So, if your client is fighting a case with the regulatory authority regarding one statutory due, that is a disputed due. If there is no case, nothing going, then that will be an undisputed statutory due. So now what are the reporting requirements relating to statutory due? What are the reporting requirements relating to, what are the reporting requirements relating to undisputed? What are the reporting requirements relating to disputed? So first we will talk about undisputed dues. When it comes to undisputed dues, I need to check whether my client company is regular in depositing all the undisputed statutory dues with the authorities. If there is no dispute lying, my client should have paid all the undisputed statutory dues regularly. Regularly means what? On or before due dates, whether my client company is depositing all the undisputed statutory dues with the regulatory authorities or not. If not, the extent of arrears outstanding, if you find some undisputed statutory dues was not paid, then I need to report extent of arrears of outstanding dues, nothing but amount of that outstanding dues as at the last day of the financial year concerned for a period of more than 6 months. From the date they become payable shall be indicated by the auditor. So what they are trying to say here, is if at all any undisputed statutory due is there which is not paid to the regulatory authorities, and those statutory dues which are undisputed, which are outstanding for a period of more than 6 months as on the balance sheet date, only those amounts are required to be reported. Once again, I am repeating, not all the undisputed statutory dues outstanding shall be reported. Only those undisputed statutory dues which are outstanding for a period of more than 6 months as on the balance sheet date are only required to be reported. Let me make it simple with the help of example. Assume your client is required to pay some GST. No dispute, nothing. The due date is 31st of January 2022. But your client did not pay till balance sheet date, 31st of March 2022. The amount is 10 lakh rupees. Is this required to be reported? No. Why? Because even though amount is outstanding, it is outstanding for less than 6 months. It is hardly 2 months. Another amount is there. They are required to pay some PF amount. Amount is 20 lakh rupees. The due date is 30th of June 2021. They did not pay it till 31st of March 2022. Is this amount required to be reported? Yes. Why? Because the amount is outstanding for more than 6 months as on balance sheet date. Clear? So this is what the reporting requirements relating to undisputed. Now coming to disputed statutory dues, in case of disputed statutory dues, auditor is required to comment on two things. What is the amount involved in the dispute, and the forum and the court or authority where the case is pending. What is the amount involved in the dispute, and the court when the court or commissioner before which the case is pending. Is it pending before commissioner? Is it pending before court? Is it pending before is it pending before tribunal? Is it pending before Supreme Court, High Court? That need to be mentioned. So two things regarding disputed dues: what is the amount involved in the dispute, and the forum where the case is pending. So this is what regarding statutory dues. Coming to 8th point, disclosure of undisclosed income. In this point, what they try to say here is, during the year, whether your client company has faced any income tax assessment. during the year, whether any tax assessment happened, like income tax right or return taken up for scrutiny. So like that, whether any tax assessment happened. And as a part of the tax assessment, has your client surrendered or disclosed some previously unrecorded income? Like some income tax raid happened, and in that raid your client has surrendered some income which he did not offer to taxation earlier. So like this, during the year, whether the client has surrendered or disclosed income as a part of tax assessments. Now as an auditor, what I need to check is, now if you are surrendering for taxation, you would not have recorded in the books also. You would have hidden that income from the books also, whatever you are surrendering now. So just surrendering before the tax authorities alone will not be enough. That unrecorded income, whether it is now recorded in the books of accounts or not, that I need to check. What they're trying to say, if as a part of tax assessment, whether any income is surrendered or disclosed to the tax authorities now, just surrendering to the tax authorities alone will not be enough. That income should have been now brought to the books of accounts also. So I need to check whether that previously unrecorded income which is offered to taxation now has been recorded in the current year's books or not. That I need to check here. Next, ninth point is regarding loans which are accepted by your client. Now they are talking about borrowings of your client, not the assets. Now they are speaking about liabilities of your client. So when it comes to loans accepted by the client, we need to report on a few points, like whether your client has done any default in the repayment. So has your company defaulted either in the repayment of principal or payment of interest? Now what do you mean by default, sir? Default means either you are not paying the money, or even if you pay the money beyond the due date, that also will come under default. So whether your client company has made any default in repayment of loans or borrowings. If yes, I need to report the period and the amount of default for each lender. Lender wise amount and period of default should be reported. Not the total amount of default. For each lender, how much period of default has been made, how much amount of default has been made, that needs to be reported. Next, I need to check whether my client has been declared as a willful defaulter by any bank or financial institution. Willful defaulter is a bad credit rating given to the company. So I need to check whether my client has taken any loan from the borrower and whether any bank or financial institution classified my client's account as a willful defaulter. That I need to check and give a comment. Third one is regarding term loans, where I need to check whether my client has taken a long-term loan, but instead of using it for the purpose which was mentioned to the banker, are they using it for other purposes? So in simple terms, if I have to put it, whether your client has applied the term loans for whatever purpose they have got it, they should not have misused it. In case if they have misused the long-term loans, I need to mention what amount of loan has been used for that other purposes and what is that other purpose for which they have used it, that I need to report. Simply if I have to put it, for whatever purpose long-term loans are taken, whether they are used only for that purpose or not, I need to check and report. Now fourth point is regarding short-term loans. In case if your client has taken any short-term loan, whether it is used only for short-term purposes or it has been used for long-term purposes, that I need to check and give a comment. Then whether your client company has taken loan for meeting obligations of your subsidiary, associate, joint venture companies. Your client has taken loan, but not for meeting your client's requirement, but for meeting obligations of subsidiaries, associates, joint ventures. Then I need to report what amount of such loans are taken for meeting obligations of the subsidiary, associate, joint venture, and for what kind of transactions they have spent it, that I need to report. Clear? Next, last point under this last sub point under this point, loans against a pledge of securities or subsidiaries. That means whether your client has taken any loan, but for loan we need to offer security. No, what has been pledged with the banker is the shares which they are holding in subsidiary, associate, joint venture. So whether the company has raised any loans during the year by pledging securities which they are holding in subsidiary, associate, joint venture. Whether your client has got any loan by pledging the shares of subsidiary, associate, joint venture. If yes, give the details like what is the amount involved and how many shares are pledged, etc. And also report whether there is any default in the repayment of such loans taken on the pledge of securities held in subsidiary, associate, joint venture. That's all. So 6 points regarding loans which are taken by your client company. What are they? Whether your client has made any default in the repayment. If yes, amount and period for each lender wise. Number 2, client is declared as willful defaulter. Number 3, whether term loans are used for the set purposes. Number 4, short-term loans are used for long-term purposes. Number 5, loans are taken for meeting the obligations of subsidiary, associate, joint venture. Number 6, whether loans are taken by pledging the securities of subsidiary, associate, joint ventures. That's all. Clear? Now, coming to the 10th point. 10th point is regarding IPO or FPO. So when it comes to IPO or FPO, they have two subpoints here. Whether your client has raised the money by way of IPO or FPO, including debt instruments. If yes, they will tell some purpose to the investors. No, for so and so purpose, we are raising this IPO or FPO. As an auditor, I need to check whatever amount that has been raised from IPO or FPO, whether that amount has been used only for the set purposes. Sir, how will I come to know about the purpose, sir? You will come to know about the purpose from reading the prospectus. So I need to check whatever money that has been raised from IPO, FPO, whether it has been used only for the purposes mentioned in the prospectus. If not, I need to report what defaults have taken place, what delays have taken place, and what subsequent rectifications are done. Everything needs to be reported. Similarly, during the year, if there is any private placement or preferential allotment, see, difference between IPO and this preferential allotment is in IPO, FPO, the offer will be open for everybody. But in the private placement of shares, shares will be issued, but only for a limited group of people. So in case if your client has raised money by way of preferential allotment or private placement, I need to check whether they have complied with section 42 and 62 of the Companies Act, which contains rules regarding this preferential allotment or private placement, and whatever amount that has been raised from that private placement, whether it has been used only for the purpose for which it has been raised. If not, if they are used for other purposes, then I need to report what kind of non-compliances have taken place. Now talking about the 11th point is regarding reporting of the frauds. So here what they say is whether any fraud by the company or on the company has been noticed or reported during the year. As an auditor, did you notice or report any fraud by the company or on the company? If yes, you need to mention nature and amount involved in the CARO. What is the nature of the fraud along with the amount needs to be reported in the CARO. Similarly, you need to comment whether any of the auditors submitted form ADT4 during the year. We have reporting requirements under 143 subsection 12. When amount involved in the fraud is 1 crore or more, reporting to central government will happen. So I need to give a comment whether any of the auditors submitted form ADT4 during the year. Similarly, even I need to give a comment whether as an auditor, did you receive any whistleblower complaints during the year? If any, how you have considered them. As an auditor, did you receive any whistleblower complaints and how you have dealt with them? So 3 points regarding the frauds. What are they? Number 1, whether you notice or report any fraud. If yes, nature and amount involved. Number 2, whether any of the auditors submitted form 84. Number 3, as an auditor, did you consider any whistleblower complaints taken place during the year? Next, 12th point is regarding Nidhi company. In case if you are conducting audit of a Nidhi company, you need to check 3 points. Whether net owned funds to deposits ratio is 1:20. Which means for every 1 rupee of net owned funds of Nidhi company, they can accept a maximum of 20 rupees of deposits only. If they have 1 lakh rupees of net owned funds, they can accept a maximum deposits of 20 lakh rupees only. So whether this net owned funds to deposits ratio of 1:20 is met or not, I need to check it. And whether Nidhi company is maintaining 10% unencumbered term deposits. Out of the total deposits which they have collected, 10% should be kept in a fixed deposit, that too unencumbered, without offering any security. So if the Nidhi company has collected total 100 lakh rupees of money, in that 10%, which will be 10 lakh rupees, that 10 lakh rupees should be kept in a fixed deposit, and that fixed deposit should not be offered as a security for any loan. So whether 10% has been kept in unencumbered term deposits or not, that I need to check. And finally, whether Nidhi company has made any default in repayment of principal or interest to any of the deposit holders. So 3 things I need to comment in case if my client is Nidhi company. Sir, what if my client is not a Nidhi company? I will mention the same fact. My client is not a Nidhi company. Reporting requirements under this clause will not be applicable. Next point, 13th point is regarding related party transactions. So in case if your client has entered into any related party transaction, you need to check whether those related party transactions are as per section 177 and 188 of the Companies Act. And regarding related party transaction, there are so many disclosure requirements as per accounting standards. I need to check whether all those disclosure requirements are given in the financial statements or not. That's all. Compliance with Companies Act, disclosure requirements as per accounting standards. 14th point is regarding internal audit system. I need to comment whether your client is having internal audit system which is commensurate, which is matching with the size and nature of the business. Nothing but whether your client company is having enough of internal audit team which is matching with the size of the company, that I need to comment. Along with that, as an external auditor, did you use the reports of internal auditors? That also you need to give a comment. As an external auditor, did you make use of internal auditor's report? That also you have to comment in your audit report. And finally, non-cash transactions. Whether the company has entered into any non-cash transactions with the directors. Did the company enter into any exchange of goods and services, barter transactions? So I need to check whether company has entered into any non-cash transactions with the directors and other related parties. If yes, whether the provisions of section 192 of the Companies Act are complied with or not. So section 192 will give you some rules and regulations regarding non-cash transactions with the directors or related parties. I need to check whether that section 192 has been complied with or not. Next one, NBFCs. If I am conducting audit of a non-banking financial institution, then I need to check. Then I need to comment on certain points whether my client company is required to obtain registration under 45 1A of the Reserve Bank of India Act. 45 IA of the Reserve Bank of India Act. So some NBFCs are required to get necessary registration under this particular section of the RBI Act. I need to check whether my client is getting covered under that section of the RBI Act. If yes, whether they have obtained that necessary registration from the RBI or not. Second one, whether my client company is conducting any non-banking financial activities or housing finance activities without obtaining a valid certificate of registration. Did my client company carry out any non-banking housing finance or non-banking or housing finance activities without obtaining registration from RBI? That I need to check and give a comment. And also, in case if your client NBFC is enjoying a status of CIC, CIC is a status given to some NBFC subject to fulfillment of conditions. So in case if your client company is enjoying that status of CIC, core investment company, as an auditor, I need to check whether they are continuing to fulfill the criteria of a CIC. Like for example sake, if NBFC fulfills some 10 conditions, they will get the status of CIC. So if my client is enjoying that status of CIC, I need to check whether these 10 conditions are satisfied or not. Now after becoming CIC, if they fulfill some extra 5 conditions, say some extra 5 conditions are satisfied, then they will get even more advanced status, which we call it as exempted CIC or unregistered CIC. In case if my client is enjoying the status of this exempted CIC also, in addition to these 10 conditions, whether these 5 conditions are also satisfied or not, I need to check. Understood everybody? So that's what they try to say here. If I read it slowly here, whether the company is a core investment company as defined in regulations made by RBI. If yes, whether they fulfill the criteria, whether these 10 conditions are met or not. And in case if the company is exempted CIC, then whether it continue to fulfill additional criteria. If it is exempted CIC, this 10 plus 5, 15 conditions are satisfied or not, I need to give a comment. And also, as a part of your client's entire group companies, is there only one CIC or more than one CIC? That means whether your client's group companies contain more than one CIC, more than one of the group companies enjoying the status of CIC. If yes, how many number of that group companies are enjoying the status of CIC? That number of CICs also I need to mention in my report. Finally, 17th point, cash losses. Whether your client company has made cash losses in the current financial year as well as immediately preceding financial year. If yes, amount of cash losses are required to be reported. Did your client company make any cash loss? See, don't confuse cash loss with loss as per statement of P&L. Both are different. Cash losses have to be calculated from the loss as per statement of P&L, loss or profit as per statement of P&L. So you have to take the figure of profit or loss from the statement of P&L, add back all non-cash expenses, reduce all non-cash incomes. The resulting figure which you get will be called as cash loss. So find out whether your client has made any cash loss for the current year as well as last year. If yes, mention the amount of that cash losses. Next, 18th point says that whether there has been any resignation of the statutory auditors. Did any statutory auditor resign during the year? If yes, find out because of what issues, what objections or what concerns the statutory auditors have resigned and how they are affecting your audit, that you need to give a comment. Just check whether any of the auditors resigned. If yes, find out what issues, what objections, what concerns are raised by them and how they are affecting your audit, that you need to have a comment here. And then finally, 19th point, in which they say that, I will give you summary what they say in the 19th point. In the 19th point, they ask the auditor to tell his opinion whether company is able to pay the liabilities which fall due within a period of 1 year, or is there any uncertainty existing. As an auditor, you need to tell your opinion. Is the company is having capability to pay all those liabilities which fall due within the next 1 year, or are they having uncertainty? Are they having any doubtfulness? Is there any doubtfulness regarding the company's ability to pay? That opinion I have to express. See, because of this particular point in the CARO, I need to comment on the future of the company. So but however, it is just an opinion, not a guarantee. So you should express your opinion. Is the company, so let me read this point in a detailed manner, whether the auditor is of the opinion that no material uncertainty exists as on the date of audit report, that company is capable of meeting all its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So whatever liabilities are there which fall due within 1 year from the balance sheet date, is the company in a position to pay all that liabilities, or is there any material uncertainty existing? That I need to comment here. And on what basis I have to give this opinion, sir? On the basis of on the basis of calculating financial ratios, on the basis of analyzing expected dates of realization of financial assets and payment of financial liabilities, on the basis of information accompanying the financial statements, and even on the basis of auditors' knowledge of board of directors and management's plans for the future. So you have to consider all this. So by calculating some ratios, by analyzing the dates of realization and payment to the assets and liabilities, by using the financial statements, and by sitting with the management and discussing the plans with them, using all this information, you have to tell your opinion, is the company in a position to pay all their liabilities as on balance sheet date, or is there any material uncertainty existing? Clear? Now 20th point is regarding CSR expenditure. Let me try to summarize this, what they try to say here. Regarding CSR expenditure, they say two things. Assume 21-22 financial year, the company is required to spend some CSR expenditure. Assume 2% of average net profits of the last 3 years. That 2% comes to 2 crore rupees. In the first point, they ask me to check if the company is not able to plan how to spend this 2 crore rupees of money within 6 months from the end of financial year, that amount is required to be transferred to the fund specified under Schedule 7. Now, what does that mean? With the help of example, we'll try to understand. Financial year 21-22, they calculated CSR expenditure, 2 crores they have to spend. Now, company is designing project. Out of this 2 crores, 50 lakhs they will give it as a donation to orphanage. Another 50 lakhs they will give it as a donation to old age home. Some 80 lakh rupees they will use it for the construction of school. A school they will construct. So this is what they have decided. Within 6 months from the end of financial year, from 31st of March 2022 till 30th of September, they are able to decide these projects. But if you observe, the total projects which they have decided is amounting to only 1.8 crores. But how much amount they have to spend? 2 crores they have to spend. So they are unable to decide. They are unable to have a project for that excess 0.2 crore rupees. That 20 lakh rupees they are not able to decide any project. And 6 months from the end of financial year is over, but still they don't know how to spend this 20 lakh rupees. Now this 20 lakh rupees should be transferred to a fund specified under Schedule 7. Sir, examples of the funds specified under Schedule 7. So examples of the funds specified under Schedule 7 are, one is PM CARES Fund, other one is Prime Minister's National Relief Fund. So like that, so many funds are there which are given to which are prescribed under Schedule 7. You need to transfer that money to the fund. Which money? The money which you are not able to plan. 6 months over from the end of the financial year, but still you are not able to plan how to spend that. So that money you have to give it to the fund. That means you are, by transferring the fund, you are giving that money to the government. Government will take care of it, how to spend. If you are able to spend it on your own, come up with a project within 6 months. If you don't come up with a project within 6 months, transfer that money to the fund, and that fund will be utilized by the government for public welfare. So that is what the first point in respect of other than ongoing projects. That means if you don't have any project, the company should have transferred that unspent amount to a fund specified under Schedule 7. If you are not able to have any project regarding the CSR expenditure, you should transfer that money to a fund within a period of 6 months of the expiry of the financial year. Within 6 months from the end of the financial year, you should have transferred that money to the fund. Once the money goes to the fund, company will lose control over it. Government will take care of it. Now, second point is regarding a project. You have a project ready, but you did not spend it. Take for example, this example only we will take. Total 1.8 crore rupees, you have a plan ready. 20 lakhs you have transferred it to government. So out of this 1.8 crores rupees, 50 lakhs you want to give it as a donation to orphanage. The company has written a check, given it immediately. 50 lakhs they want to give it as a donation to old age home. They have written a check, given it. And finally they have 80 lakh rupees. They want to construct a school. But as we know, school construction will not happen in a day or two. It will take significant amount of time. So 80 lakh rupees, you have a project ready, but you did not spend it. You will spend it. 80 lakh rupees, you will spend it on school construction only, but it will take some time. So that money which you did not spend relating to an ongoing project, that should be transferred to a special account. Nothing but a separate bank account you have to open, and in that bank account you have to keep this money. See, when you transfer that money to the bank account, in the second case, company only will have control over it. Company only will spend it. For what purpose they will spend it? For social welfare only they will spend it. But just for segregating the normal funds with CSR funds, they are asking you to transfer this 80 lakh rupees to a separate bank account. So you have a project ready, but you did not spend the money yet. You will spend it in the future. Slowly you will spend it. But till the time you spend it, keep it in a separate bank account. But what is the first point? You don't have a project at all. Since you don't have a project at all, you have to transfer it to the funder. That means you have to give it to the government. Clear? So these two things I need to check. If I read the B point now, whether any amount remaining unspent relating to any ongoing project, pursuant to any ongoing project. That means you have a project ready, but you did not spend it. That money has to be transferred to a special account. That money has to be kept in a separate bank account. Clear? And then finally comes the 21st point. This will come only in the audit report of consolidated financial statements. Here what they simply say is, whatever company's information which is getting included in the consolidated financial statements. So as we know, consolidated financial statements includes holding company, subsidiary company, associate company, joint venture company. You need to go through individual audit reports of all these companies which are included in the consolidated financial statements. Particularly, you have to go through CARO reports of all these companies and find out in any of this company's CARO report, is there a negative remark? If yes, I need to mention in the consolidated financial statements audit report which company contains that negative remark and which paragraph contains a negative remark that I have to mention. So while conducting audit of consolidated financial statements, the auditor should go through individual audit reports of all those companies which are included in the consolidated financial statements, find out whether there is any negative remark. If yes, in the consolidated financial statements audit report, he should mention which particular company's audit report contains a negative remark and which paragraph contains a negative remark that needs to be mentioned in the audit report of consolidated financial statements. So this is what point number 21. So whether there have been any qualification or adverse remark by the respective auditors in the CARO reports of the companies which are included in consolidated financial statements. If yes, indicate the details of the companies along with the paragraph numbers of the CARO report. Clear? So this is what 21 clauses of the CARO are. Understood everybody? And one more thing here, all these 21 matters are required to be reported whether or not you have positive responses or negative responses. In all the cases, you have to report on all the 21 matters. So we are almost done with the, not almost, we are done with the audit reporting revision. But I think one more small question will be there. That too regarding how one more small concept is there that anyhow I will try to revise it. How AS1 will have an impact on the auditor's opinion. How AS1 will have impact on the auditor's opinion. So this is one particular small concept which was there in RTPs, MTPs, etc. So how AS1 will have an impact on auditor's opinion, in which they say that because of AS1, sometimes you are required to modify your opinion. When you should modify the opinion? We should modify the opinion in case whatever disclosure requirements are there which are as per AS1, if those disclosure requirements are not given, or if any of the three fundamental accounting assumptions are violated, like going concern, accrual, consistency. If any of these three fundamental accounting assumptions are violated, or if the disclosure requirements as per Schedule 3 or Companies Act are not given, then the auditor should modify his opinion. One small question. So let me show you that question once. So just for your convenience, I will show that once. So if you see here, right. So if you see here, what are the disclosure requirements in auditor's report as per AS1? So very simple. If the accounting policies which are required to be disclosed under Schedule 3 are not disclosed, if you are not disclosing the reporting requirements as given under Schedule 3, or if accounts are not prepared on accrual basis, or if the fundamental accounting assumption of going concern has been violated and no disclosure has been properly given. And also when proper disclosures regarding changes in the accounting policies, that means consistency is violated. So in these circumstances, you need to modify your opinion. So just one normal general question. If they ask you how AS1 will have an impact on the auditor's opinion, this is what you need to write. Just simple 4 points. 3 fundamental accounting assumptions are violated, or disclosure requirements under Schedule 3 are not given. So this is what I thought of revising the chapter audit reporting, important chapter. So there were attempts in which some 12 to 15 marks were also tested from the revision, whatever we had in this video. Clear? So thank you guys. Thanks for your patient listening. Thanks for your patient listening.